Wednesday will be big. What we really want to focus on is what's known versus unknown.
It's been incredibly clear what the Trump administration is trying to do. How much disruption are they willing to tolerate?
What we know about tariffs is tariffs increase costs. How much they increase consumer prices remains to be seen.
Tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect.
I don't think these worst-case outcomes are coming to pass.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday with trading floors across the planet focused on one thing.
Liberation Day.
Liberation Day.
This is the beginning of Liberation Day. We're going to charge countries for doing business in our country.
We're in the process of imposing reciprocal tariffs.
Friend has been oftentimes much worse than foe. That money's going to be coming back to us in the form of tariffs.
The most beautiful word in the dictionary is tariff.
So-called Liberation Day, leaving investors bracing for a major tariff push. Multiple proposals sitting on the president's desk, including a tiered tariff system and a more customized plan. Anxiety is already sky high and confidence is already rock bottom. Consumer sentiment the weakest since 2022, and by one measure, long-term inflation expectations the highest in decades. For markets, Evercore is framing the $1 trillion judgment call. Is Trump going to use Liberation Day to score concessions from trading partners, or is President Trump willing to tolerate a near-term case of stagflation to reshape the U.S. economy? We're counting down to 4 p.m. live from the Rose Garden.
This is the key question. Is this the kickoff until May 4th and then June 4th and then July 4th when we get a series of negotiations? Or is this a real bazooka to try to reshape trading agreements in a way that we haven't for possibly more than 100 years? Look, Scott Bessent yesterday, Treasury Secretary, came out and said that he does expect that this would just be a cap and that countries can barter to get those down. A lot of people bracing for what could be the worst case scenario, but expecting and pricing in something a lot less.
So this is what we don't know. We don't know which proposal the president will choose. We don't know how others will react. We don't know what can be negotiated. We don't know what will be exempted. What do we know this morning?
Well, we do know that they're still weighing all of these options. And we do know that there are a number of proposals, as you mentioned, on the president's desk. I think the best way to think about this is the president is going to come out with a very big shock and awe number, a universal tariff rate for everyone. Or it's going to be more customized, whether it's two-tier or reciprocal. It'll be more customized depending on that country. One thing is for sure, this is a president who definitely likes to negotiate, but potentially negotiations will happen later in the year because they need to offset the revenues. They need those revenues to offset the tax cuts.
This, of course, is just one dimension of the overall policy platform, but a consensus view is that it introduces upside risk to inflation and downside risk to growth. And that puts the policymaker over at the Federal Reserve in a very tricky position.
Which is the reason why it's really going to be fascinating to hear what Fed Chair Jay Powell says on Friday after the non-farm payrolls report. Yesterday, as some of the prognostications about stagflation came to the fore, you saw the greatest number of rate cuts getting priced in this year. You saw more than 3 rate cuts by the Federal Reserve getting priced into a market that is seeing a Fed that responds more to growth concerns than it is inflation. This is the key question, though. How are they going to really respond in a material way if you do see companies already raising prices before we even get the tariffs to offset some of their manufacturing costs?
We get more data later this morning, 8:15 Eastern Time, the ADP employment report. The estimate in our survey, 120, the previous number, 77. Coming up this hour, we'll catch up with Peter Tchir of Academy Securities as stocks post back-to-back gains. Former NEC Deputy Director Everett Eissenstat on Trump's economic agenda, and we'll speak to Andrew Hollenhorst of Citi as the economy braces for more tariffs. We begin this hour with our top story. The world awaiting President Donald Trump's tariff announcement at 4 p.m. Eastern Time from the Rose Garden. Joining us from the nation's capital, Bloomberg's Mike Shepard. Shep, what can we expect at 4 p.m. Eastern Time?
Well, I think as you highlighted right at the open, John, it is a wide open question. It's unclear what we're going to get. We can see markets and companies on knife's edge awaiting what will come out of the president's mouth as he utters this and whatever he signs. It really is those 3 different options that we have heard about. It could be a tiered system. It could be something more bespoke, customized tariffs, or it could be the flat rate that the president talked talked about when he was seeking election to a second term. Now, all of this has a huge impact on markets and on companies. They are going to have to make decisions about spending and investment. And for the president and his team, they actually see the tariffs as a tool for bringing manufacturing back to the U.S. But remember, it's taken decades to build those supply lines, and it will take years to build those plants here in the U.S. This is going to be a complicated moment, and it will also touch off some negotiations. Scott Bessent, Treasury Secretary, indicated, as have other administration officials and the president himself, that they are willing to talk. But it will take time to get those kinds of conversations underway. And they're also going to be hearing from industry, too, seeking some sort of a break, some sort of a concession, as we saw automakers do earlier this week, trying to get some sort of relief when it comes to lower cost parts.
Mike, you covered Trump during his first administration. What makes this time around different or similar?
Well, it's similar in some ways in the sense that he is going to the 11th hour with this plan. We really haven't gotten a clear sense of the direction of travel with what the president will be coming out with tomorrow. There's been no pre-briefing. We're seeing a lot of different options on the table. One thing that's different here, though, is that the president really does seem to have some sort of plan for something big in mind, and he really does want to leave a mark. And he has been telegraphing this day for weeks, and he really does want to make an impact. One of the administration's regrets the first time around was that they missed a few opportunities, perhaps, owing to not understanding exactly how the government works and the mechanisms and the levers that they can pull. So they have brought in a team of more seasoned people, especially on the trade side. Jamieson Greer, the U.S. trade representative, was the chief of staff to Robert Lighthizer, who was Trump's trade chief the first time around. And we also have, of course, Peter Navarro, who is back in the White House as a key advisor on trade as well to Trump. So they have a better sense of what they want to do, how they want to do it, and they also have a goal in mind, too, here.
Hey, Shep, appreciate the breakdown of things. Appreciate your time, sir. Mike Shepard of Bloomberg down in Washington, D.C. Already getting some breaking news from the team here at Bloomberg this morning. This, according to people familiar with the matter. China has taken steps to restrict local companies from investing in the United States. The story goes on to say that several branches of China's top economic planning agency, the National Development and Reform Commission, have been instructed in recent weeks to hold off on registration and approval for firms that are looking to invest in the United States. The latest breaking news from the team here at Bloomberg.
This news seems to go on beyond the concerns about national security and capital outflows. These new measures underscore the tensions that are building under Trump 2.0 between Beijing and Washington. And this is a ton of money. 2023, China's outbound investments into the U.S. totaled nearly $7 billion. So this is China preparing, coming out retaliation even before Trump has his announcement at 4 p.m.
Lisa, this will complicate things for sure when it comes to investment, but this might be music to the ears of some congressmen who have been pushing for the same kind of thing down in Washington, D.C. for a number of years.
To decouple the two economies, they don't necessarily want to see those ties get that much closer. Unclear how much leverage this actually gives China, but what you can see pretty much around the world is trading partners with the U.S. looking how to tighten the screws ahead of the announcement that they expect will be the launching point for possible discussions.
Equity futures this morning negative by 0.4% on the S&P. Let's talk about the market. Peter Tchir of Academy writing the following: the consensus that uncertainty is bad and that almost any announcement will create certainty so we can rally is wrong. Pete joins us now for more. Pete, good morning.
Good morning.
Suggestion there that you don't think this is the clearing event that leads to a big rally?
No, not at all. Maybe we get a little pop because everyone's kind of built that way, but I think there's plenty of other problems going on. So I don't care what sort of number comes out tonight. Look at how people are treating the U.S. very, very differently this time. China, for example, Trump 1.0, Xi was one of the first people to come, came to Mar-a-Lago. Every time Trump met tariffs, Chinese trade delegations. China's just sitting there, yes, sir, may I have another? Yes, sir, may I have another? They're going on. And this is starting to play out into their long-term goal, right? We've always talked about this, China trying to switch from made in China to made by China, their brands. They're now negotiating with South Korea and Japan about deals, right? That's clearly nervousness about what the U.S. is going to do in the region. So I think tariffs have taken up all this time, and that's a big part of it. I think when you look at the geopolitical front, we've made a lot of issues there with NATO, with Greenland, with Canada as a 51st state, with Panama. I think there's a general frustration there. And at the same time, domestically, DOGE has been running around. It's very unclear what's been accomplished, not accomplished, except for a lot of uncertainty. I think these things are all kind of meshing together. And once people have a chance to sit down and figure out whatever tariffs we're on, They're like, ooh, this is not good. And to me, I think we have been in the process of destroying the American brand, and this hope that country after country would come and beg for a deal is changing rapidly.
You sound super bearish. How much downside is there?
I think we've got at least another 10 or 20% on stocks from here. Again, you start looking at the mistakes we've made. As far as I can tell, nothing about tariffs so far would have stopped American farmers from selling their produce just like they did last year. Yet we're now talking about bailouts for farmers. Why? Because a lot of the input, nitrogen, fertilizer, potash, comes from Canada, and we slap 25% tariffs. So I think the rest of the world's watching mistake after mistake be made. They're trying to figure out what it means in Greenland, right? We used to have 3 military bases there. Why not ask for 3 again? There are all sorts of ways this could have been played, and yet we keep going down this path that seems to work. Annex. You talk about Canada as the 51st state. There was a while, okay, maybe Trump can say it and it's kind of cute or it's Trump, but he went on, and then Howard Lutnick started talking about that. Now you have a relative, senior within the U.S. world, but not global stage. I think the world is taking a look at this and saying, do we want to deal with the U.S. if we can avoid it? There's going to be some things that near term they have to. You're going to see a lot of trading relationships change, right? Canada and Mexico had a bilateral call the other day, supposedly, right? People are saying, we do not trust the approach. We do not like the approach. And I think, as Shep just mentioned, right, it's going to take years to build up the capacity. So even if people wanted to make steel and things here, it's years, and we've gone this path that I think is alienating everyone.
Just to frame this, in your recent note, you even brought up the old saying that the sun never sets on the British Empire. So you definitely are coming from a pretty negative place at this point, especially with 10 to 20% downside
right.
on your
you kind of sit there like, what was Queen Victoria looking at? And even I go back to Nikkei in late 1889, coming into 1990, right? Were people in Japan like, oh my gosh, we're about to go down 60% and not recover for 30 years? I suspect they weren't. And I feel there's almost this hubris right now. And we keep talking, you hear from the administration, we have all the cards, I don't know which cards we have.
Okay. There's also this saying that American capitalism and American companies manage to do well despite the best efforts of the U.S. government to torpedo them again and again. And that despite some of the dysfunction that you get in Washington, D.C., decade after decade, there has been this real dynamism in the corporate sector. What makes you think that will not win out this time around?
So, great point, right? I think 35 to 40% of S&P 500 company earnings come from overseas. If you told me 3 months ago Germany was going to go crazy and spend a bunch of money on military equipment, I would expect record highs for U.S. defense stocks. That's not happening. Why? Because Germany doesn't trust U.S. purchases of military equipment, right? You're seeing that hit some of the other brands. And I keep coming back and, to me, given my family history, there was a time Levi's were a symbol of freedom, right? People, especially in the Soviet Union, viewed that. And even to this day, I think there are a lot of American brands that are aspirational to people across the globe. They look at these brands, they want to be associated. Maybe it's Nike, be like Mike. Whatever you want, there is an association that's been positive with that U.S. I think you're starting to see some of that slip, and that becomes very problematic.
When it comes to, though, Trump's entire plan holistically, you're just really focused on some of the rhetoric that we have not actually seen play out yet, as well as tariffs. What about deregulation that might happen, the idea that they want to move more spending to the private sector, as well as the extension of tax cuts?
So one, I think, had this been done over years, that'd be great. And I think, as a Canadian, I'll say this, he probably should have used Canada for the natural resources for 2 or 3 years to help rebuild the industry here, and then maybe screwed Canada. Again, Canada is a net importer of U.S. manufactured goods. Canada just exports mostly energy to the U.S. So there's not been a clear path. The other problem is, everything's been executive order. We haven't even got good executive orders yet on deregulation. This has to go through and get passed by the legislation. Otherwise, are you really going to come to the U.S. and decide you're going to make a chemical plant somewhere? It's going to take you 2 years to get approvals, this, that, and the other thing. You're probably not going to break ground for 3 or 4 years. All these rules could be reversed. Someone could come in or slap different tariffs on you, or environmental rules, new things on you. So I think this whole working by executive order is not going to be sufficient to get people to do these things.
Take out the government. Where else do you want to go if it's not America?
I think everyone's going to start trying to figure out how can we work elsewhere, right? China, unfortunately, I think China should be our strategic enemy. I think it was, but China seems to be the big beneficiary of this, right? They are already talking to other people. I'm sure if you're Canada and you're like, well, which country in the world uses a lot of resources if we can't sell our resources to China? I think these conversations are playing right into China's hand. There is a global economy. And this, again, the U.S. is the biggest, right? 30 trillion, call it GDP. The rest of the world's 80 trillion. I'm not sure why we picked 30 trillion versus 80 trillion fight, right? In military terms, right, one of the first things you probably learn is divide and conquer. Well, we've done the opposite of divide and conquer, right? We've pushed everyone into a corner. We've been erratic. I think people are trying to figure out where we're headed, and it's no longer as clear what's happening here. And the other part, even on these tariffs, I'll harp back. Every single country is probably looking at every single tariff they have and analyzing, okay, we can give on this one because it doesn't make a difference. We'll fight on this one because it makes a difference. There is no way the U.S. is spending line item by line item time, given our resources, so we are going to get probably picked off in any negotiation.
Just briefly, what's your base case for 4 p.m.? What do you expect to hear?
I expect something moderate in that 15%. I don't think he can back all the way off because then his base, it would look like a loss for Trump, right? He's been talking such big thing about tariffs. I think he has to go kind of middle of the range. He might go full in. That does tend to be his tendency. I think maybe you get a brief pop because, we got the certainty. And then I think over the coming weeks, we realize we have done so much damage to the global economy, to supply chains, that we continue to sell off, and all the buy the dippers get hurt really badly. I keep watching as my probably biggest tell is TQQQ, which is a triple leveraged, ETF. It has had mostly inflows. I want to see that thing kind of get annihilated, true capitulation there. Then I can get comfortable that the worst is behind us.
Peter Tchir of Academy Securities. Couldn't get much more bearish. It's good to see you, Pete. As always, thanks for breaking it down. If you want an equity bull, Binky Chadha joins us later of Deutsche Bank. Still got a price tag on the S&P of 7K for year end. We'll catch up with him a little bit later. Equity futures at the moment pulling back by 0.4% with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hacker. Say Yahara.
Hi, John. President Donald Trump set to make his tariff announcement at the 4 p.m. Eastern in the Rose Garden. Several proposals are still set to be under consideration, including a tiered system with a set of flat rates for countries, as well as a more customized so-called reciprocal plan. White House Press Secretary Caroline Leavitt saying the tariffs will take effect immediately. Meanwhile, China is restricting local companies from investing in the U.S. That's according to people familiar who say several branches of China's top economic planning agency have been told to hold off on registration and approval for firms looking to invest in the U.S. The decision does not appear to impact existing commitments or China's purchases of U.S. financial products. And Newsmax is falling 24% in the pre-market. The drop comes after shares of the conservative media outlet surged over 2,000% in its first 2 days of trading. Its tremendous rise coming despite concerns about the company's fundamental value and ongoing litigation. That's your Bloomberg Brief. John?
Phenomenal rally. Yahara, thank you. More from Yahara later on this morning. Up next on the program, unleashing major tariffs.
They will be effective immediately. And the president has been teasing this for quite some time, as you know. He's talked a lot about April 2nd as Liberation Day. It is going to work. We are focused on restoring the golden age of America and making America a manufacturing superpower.
It's the golden age of volatility. Up next on the program, the former NEC Deputy Director Everett Eissenstat joins us, and later we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge, the former Trump trade advisor Kellyanne Shaw, and the former Obama economic advisor Jason Furman. Live from New York City this morning. Good morning. Just about putting together 2 days of gains on the S&P 500, taking some of it back this morning. We're negative 0.4% on the S&P. On the Nasdaq, we're down by 0.5. Under surveillance this morning, unleashing major tariffs.
They will be effective immediately. And the president has been teasing this for quite some time, as you know. He's talked a lot about April 2nd as Liberation Day, but tomorrow will be the day, and he's been talking about it for a while. It is going to work. And the president has a brilliant team of advisors who have been studying these issues for decades. And we are focused on restoring the golden age of America and making America a manufacturing superpower.
So here's the latest this morning. President Donald Trump's big tariff day arrives. Economies around the world bracing for so-called reciprocal tariffs, set to go into effect immediately after this afternoon's announcement. Joining us now to discuss, the former NEC Deputy Director Everett Eissenstat. Everett, welcome back to the program, sir. From your standpoint, from your perspective, do you believe this is the starting gun for a new round of negotiations, or do you believe this administration is willing to tolerate some pain to rebalance the global economy?
I actually think it's both. I mean, he's said repeatedly that tariffs have different purposes. I still think he would like to fulfill all those purposes, both reshoring manufacturing back to the United States, but also getting countries to alleviate some of the unfair trading practices. Tariffs are certainly part of that, and so I think there's going to be a combination of both. But at the end of the day, I think the tariffs will be in place for quite some time.
Everett, how do you do both? How do you gain enough revenues to offset the tax agenda the administration wants, but at the same time negotiate better deals for lower tariff rates?
There's definitely a little bit of a contradiction there, and I don't believe that anyone thinks that the tariffs in of themselves can replace the income tax, for example. So they could be a partial way to offset some of the tax cuts and other government expenditures. And at the same time, there may be economies where we're able to get significant gains through negotiating on the diminishment of unfair trading practices. So I do think you can do both. I could see a scenario where we have a baseline tariff, I just make a number, say 10%, and then perhaps you have higher tariffs on some countries that are seen as bad actors, and perhaps even tariffs on certain sectors that rise above that baseline tariff. So I think it's possible to do both. It's complex, but it's not something that couldn't be done.
We've been discussing all morning these three potential approaches we're going to hear from the president today. A universal tariff, a more customized reciprocal tariff, or a tiered approach. What you just said right there is potentially the president's going to come out with a little bit for everyone. Is that accurate?
We'll see. We'll see. It's certainly possible. I think there's a way to formulate these where you could achieve all three outcomes. Now, none of them are going to be exactly targeted perfection. But this is a bit of a moving target, as we've seen. And I think the president and some of his advisors have said they want to use these for many purposes. They want to use them to raise revenue. They want to use them to alleviate unfair trading practices. And I think they will continue to use tariffs in that way. It enables them to have a lot of flexibility to respond to situations and take advantage of opportunities. We've already seen that some countries are coming to the table and asking what they can do to get a better deal. And I think that's part of the president's strategy.
If you were still in the National Economic Council and you just heard the likes of Peter Tchir of Academy Securities talking about the damage already being done, whether it's business confidence, whether it's the American brand, whether it's just generally consumers feeling a bit lost and concerned about inflation, how concerned would you be that the process of this whole tariff negotiation is doing more harm than good in the way that it's being rolled out?
Well, you've made a really good point. I mean, a good idea is a good idea, but execution is key. And the execution, the more predictable it is, the more transparent it is, the more people feel they've had an opportunity to have input and understand what's coming, I think the better outcomes you're going to get. Now, the president has been projecting that this has been coming for quite some time. They've floated out different ideas. And one of the, I think, hallmarks of this presidency is putting out feelers, getting a sense of where companies and governments are going to land. And I'm sure that they've had a lot of discussions with many, many stakeholders leading up to this date that have impacted what they're going to do and how they're going to do it today. But for businesses, predictability is key, and hopefully today will be the beginning of some clarity and predictability on how these tariffs will be rolled out and how long they'll be in place, and of course at what rate they will be.
We all hope you're right, sir. That's for sure. The former NEC Deputy Director, Everett Eissenstat, joining us live from Washington, D.C. Will we get that much-needed clarity?
So something Everett said there is something actually I heard from someone as well. You can have a mix of these scenarios and proposals. A lower universal tariff plan, which would basically assuage all the concerns, especially of the president's base that he promised to do. And then a more customizable approach for some of what the president would deem the worst actors when it comes to trade.
It also seems clear that he wants to start negotiations. So if he wants to start negotiations, how much clarity can you get? I love Jordan Rochester of Mizuho coming out and giving a prescription. 10% risk rallies, anything closer to 20%, forget about it. And that seems to be how people are thinking about it.
Equity futures right now in the S&P negative by 0.5%. Up next on the program, Terry Wizman of Macquarie as the president is set to make a major tariff push, looking for a major realignment of the global economy. From New York City, this is Bloomberg. Counting you down to a major tariff announcement. Live from the Rose Garden at 4 p.m. Eastern Time, the President of the United States unveiling what we've been waiting for weeks and weeks and weeks. We should get the numbers later this afternoon. Equities right now pulling back by 0.5% on the S&P. 2-day winning streak coming into Wednesday. We take some of it back. We're down 0.6% on the Nasdaq 100 with 3 hours from the cash open. Here are your morning movers with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Newsmax falling 25% here in the pre-market, giving up some of the tremendous gains we've seen from this company since it started trading on Friday. Its IPO priced at $10, and look at it now. It is still a $173 stock, with the market cap now greater than its conservative news rival Fox. Next up, we have Tesla. It is falling 2.3% here, leading the Mag 7 lower. We're expecting Tesla to report deliveries before the bell today, giving us a look at how Elon Musk's polarizing position in the Trump administration is impacting sales. And we know that analysts have already drastically brought down their expectations for this. And just in the last few minutes, we did get a headline saying that Tesla's deliveries in China for the month of March are down 11.5% year on year based on PCA preliminary data. So that also weighing on the stock. And last up, I managed to find a riser for you, and that is Petco. It is up 7%. And the reason behind this pop is that its CEO, who's fairly new, bought $4.7 million worth of stock. So this signals a vote of confidence by him that he can turn this company around, because due to competition like Chewy, the online marketplace, Petco has really lost out on the tremendous growth we've seen in the pet industry. John?
Yahara, appreciate it. More from Yahara later on this hour. On our radar this morning, our top story. President Donald Trump's team finalising plans for reciprocal tariffs set to be unveiled at 4 p.m. Eastern Time. Sources telling us here at Bloomberg they have not reached a firm decision, with several proposals still under consideration.
So Trump will come out potentially with the shock and awe moment, because we do not know yet, out of those three on the screen right there, which one he is going to pick. Universal, across the board, everyone gets the same tariff rate, a more customized reciprocal, or a tiered approach. Maybe 10% for this group of people, 20% for these others. The problem right now is the uncertainty is so high going into this, and people are concerned whether or not this is going to be something that sticks or it's the beginning of a negotiation. And if that's going to be the outcome, then the uncertainty is going to be pervasive for the next weeks and months.
We also don't know how companies will react, how they'll respond. Check this out from Walmart, continuing to push Chinese suppliers to cut prices to offset Trump's tariffs. Sources telling us here at Bloomberg the company, Lisa, is still asking for 10% price cuts for each round of tariffs, even after government officials summoned executives from the company.
First of all, Walmart has a much better position than a lot of other companies from the United States. And I think it's fair to see that because of that position, they're going to use that to try to leverage and actually jawbone down prices more significantly. Why? Because right now, consumers want lower prices. They do not want higher prices, and that is why Walmart is going to be as hard as they can to try to get someone else to absorb that. Key question, number one, retaliation from the Chinese government. Walmart's in a better situation. But number two, can their suppliers handle a 10% price cut if they're essentially going to be taking losses?
As we know, consumer sentiment has already been hammered over the last few weeks, anticipating potentially higher prices. We're all trying to read the political tea leaves. Take a listen to this. Elon Musk candidate losing in a Wisconsin judicial race. The result coming after Musk poured roughly $20 million into the campaign, making it the most expensive judicial race in U.S. history. This coming as Republicans held onto 2 House seats in Florida.
I think what's interesting about the 2 House seats in Florida, this is the 1st and 6th district. One of these is Michael Waltz's seats, who's now Trump's national security advisor. The other one is Matt Gaetz, is the margins. The margins were much tighter with the Democratic opponent than many were expecting. And these are very red districts that Trump won by large margins. So I think when you put this all together, a bit of a litmus test in potentially how Americans are feeling with what has been going on in the first 10 weeks of the Trump administration.
18 months away from the midterms as well, something to consider. Equities right now, if you're just joining us, and welcome to the programme, negative by 0.5%. Let's turn to Europe, the continent bracing for President Trump's tariff announcement, with European Commission President Ursula von der Leyen saying the bloc has a strong plan to retaliate and will use it if necessary. Joining us now from Berlin, Bloomberg's Ollie Crook. Ollie, how is Europe preparing for this moment?
So, Jonathan, I think they have probably more than one plan. They'll have a set of different menus that they're going to have available to themselves, depending on what we get from Donald Trump from the Rose Garden a little bit later today. And each of those will have to deal with sort of different, not just the scope of what the actual tariffs are themselves. You've talked about the three different options. I think what is also very important for European policymakers is what economic rights are they trying to put right, the Trump administration? Is this just a question of closing that trade deficit that exists with the EU to the tune of about 200 billion euros? That is a $1 trillion relationship. Or is this about trying to achieve other economic aims? This is also potentially aimed at getting rid of the value-added tax within the EU. Is this potentially going to look at sort of regulation, at digital taxation, all of these sorts of things? And if they are going to do some of those measures in order to try to change other parts of EU policy, the EU could, for the very first time, use their anti-coercion instrument. This is a new legal instrument that's been around for about 4 years. It is basically designed to push back against other sort of coercive measures that are brought by other governments. So that goes beyond sort of trades in goods and services. This could also target foreign direct investment. This could target intellectual property, procurement, all of these sorts of things. And also the important part of the sort of calibration from the Europeans, we should not lose sight of the fact that hours after these tariffs go into force, we have former Senator and now Secretary of State Marco Rubio arriving in Brussels for a NATO summit. The Europeans do not need to be reminded how dependent they are on the United States, A, for their own defense, but B, also for a resolution on Ukraine that they can live with. This is all going into the input of the equation of how they will respond to the U.S. president a little bit later today.
Ollie, in markets right now on Wall Street, we're all trying to figure out whether this is just the starting gun for another round of negotiations or whether this really is the real deal. How do you think the European officials are thinking about that? How do they answer that question?
I think that they honestly don't know the answer to it at this stage. I mean, I think, again, they're trying to get the maximum number of options available to them. And I think that also for the private sector, I mean, we've just been talking to CEOs over the last couple of days. You'll remember when we spoke to BMW a couple of weeks ago, they tried to put a price on what this would, the impact that this would have. We're talking about just the Mexico-Canada tariffs was going to cost them 1 billion euros. That is to say nothing of 25% tariffs that sort of will be erected over the sort of Atlantic Ocean. That is going to be absolutely mammoth. We've seen now from Mercedes-Benz overnight talking about how basically they're going to abandon their entry-level SUVs in the United States potentially if these tariffs come into play. This is all going to become very, very real, go from the abstract into the reality very, very soon. And for the European officials, they need to be very careful because if they sort of erect trade barriers in the other direction, BMW makes a load of their cars in the United States that they ship over to Europe. Same thing for Mercedes-Benz. So that is, again, part of the delicate line that these policymakers here in Europe need to walk.
It's going to be a long night for the Europeans, that's for sure. Ollie, appreciate the time as always. Ollie Krug, live from Berlin. Let's extend the conversation with Terry Wizman of Macquarie, writing the following. Unlike the 2018 tariffs, the 2025 tariff round comes with rising inflation expectations. This stagflationary dissonance makes it too early to buy stocks because the Fed is not yet your friend. Terry joins us now for more. Terry, good morning.
Good morning, John.
What would make the Federal Reserve our friend?
Lower inflation, and certainly lower inflation expectations. And they're certainly not seeing that now. You can see it in the University of Michigan survey, for example, where long-term inflation expectations, the 5 to 10-year inflation expectations coming off the survey, were at 4.1%. That's telling us that if the Fed starts to reduce rates today, there will be a loss of credibility because we're not talking about the public seeing this as a one-time increase in prices. The public is now starting to get concerned, households are starting to get concerned that this is a long-term inflationary problem coming off of tariffs. And when you have a long-term inflationary problem that the Fed chooses to ignore, let's say by cutting interest rates, it would impair and impede the Fed's credibility going forward. So the Fed is not of a view right now, I believe, to cut rates into any economic slowdown that might arise from the tariffs, unless that economic slowdown gets very, very significant or unless there's a financial problem associated with it.
Right now, you see the market pricing in more than 3 rate cuts by the end of the year. Is the market wrong?
I think so, for the reason I just mentioned. I think it's too early to anticipate aggressive rate cuts from the Federal Reserve. When inflation expectations are rising in the surveys, when inflation expectations are rising implicitly in break-evens, the Fed should be mindful of this, and it should say, you know, we have a dual mandate, yes, but the problem right now may be a slowdown, but it certainly is rising inflation expectations. That's something they need to address head on.
How do they really gauge the fact that we're getting a lot of uncertainty and a lot of pullback in consumer and corporate spending at a time where we keep talking about how this is the opening salvo? There's going to be a negotiation, there's going to be more clarity, and then people will be able to move on and formulate plans. Can you start talking with some certainty about this type of slowdown, even if we get that type of clarity?
I don't think anyone could talk with any degree of certainty right now. And you're absolutely right to suggest that this is what we're going to hear this afternoon is not the last round. The fact that there's going to be retaliation assures us that this is not the last round. The fact that if these are Section 301 tariffs and they're mandated under that law, it requires the president to enter negotiations with trade partners. So we know that's going to happen as well. So there's a lot of things that can happen between now and the next 6 months. And I agree that the Fed has to wait in that context. And by the way, we're talking about tariffs. Of course, there's a much broader policy agenda coming from this administration as well. It's not just about tariffs. It's about deregulation, for example. It's about tax cuts. What if we announce the tariffs today? What if there is retaliation? What if the economy starts to slow? But the administration's reaction to that is to do other pro-growth measures, like trying to reduce taxes, like trying to deregulate the financial sector and the energy sector. And then all of a sudden we have a little burst of positive confidence in the next few months. That's something else the Federal Reserve needs to consider when it determines what to do. But I think in the context of this, a wide range of possible outcomes, the best things for central bankers to do is not to overreact.
But it doesn't sound like you think tariffs are transitory in terms of their effect on inflation.
Oh, if there's a trade war and there's a back and forth, right, where I do some tariffs and you do some tariffs and I do some tariffs against that, then they're certainly not transitory. They're certainly not one-off. There could be an extended round of positive tariff impulses and inflation impulses that come off of a trade war. That's altogether possible as well. It depends on how things are going to be conducted in diplomatic halls more than it's going to be about what the Federal Reserve does at this point.
What is your base case going into 4 p.m.? There's 3 proposals sitting on the president's desk. I'm told it's a close hold, and there's really no decision just yet.
I can tell you what I'd like to see. I'd like to see a more differentiated, discriminatory approach to tariffs on your trade partners, because what that means is that not everyone is treated equally. And that's logical. Not everyone treats the U.S. the same way. India has very high tariffs. The Europeans might have low tariffs on merchandise. And if you do have a differentiated approach, what you're going to be forced to do also is explain to each trade partner why your level of reciprocal tariff is, in fact, your level of reciprocal tariff. You have to highlight what the offending issues are. And once you do that, it sets a basis for a negotiation. Bilateral negotiation, mind you, but a negotiation nonetheless. If you simply come out and say, well, everyone's going to get a 20% tariff, even if they don't have anything offending on their books, well, then what is the basis for negotiation? Right? You want to have detail, because detail makes your counterparty focus on what the problems are.
How wide is the spread between what you'd like to see and what you expect to see?
It could be worse than what I expect to see. It could be better than what I expect to see. It's a wide range of outcomes potentially, but like I said, I think, and I don't know if the whole market agrees with me. I think some people like to think that a simple model is the best model. I don't think so. I think the simple model would be the worst model. The detailed differentiator model would be the best model. Again, not because it means a stronger economy, not because it necessarily means lower inflation, but because it provides a basis for negotiation and discussion.
Terry, it's good to see you.
My pleasure.
Ready to break it down. It's going to be a long trading day. Terry Wizman there of Macquarie. Thank you, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hacker. So, Yahara.
Hi, John. France's far-right party plans to protest on Sunday against what it calls a tyranny of judges after former party leader Marine Le Pen was convicted of embezzlement this week. The appeals court said in a surprise statement it should be able to rule on Le Pen's challenge to her conviction by mid-2026. Meanwhile, President Trump is set to be planning a meeting with top officials today to consider a proposal for divesting TikTok's U.S. operations from its Chinese parent, ByteDance. Sources say Trump is considering a deal that would include Oracle and Blackstone. The deadline to find a buyer is Saturday, but Trump has said he would be willing to extend. And U.S. Senator Cory Booker set a chamber record with a speech that lasted over 25 hours. It was a symbolic protest by the New Jersey Democrat against President Trump and Elon Musk. The speech broke a record set by Senator Strom Thurmond, who spoke for 24 hours and 18 minutes in a failed attempt to defeat the Civil Rights Act of 1957 with a filibuster. That's your Bloomberg brief. John?
Yahara, thank you. There's only one question on all our minds. How?
Here, I have some answers.
Okay,
first of all, at the very end, he said he wants to go a little past this time, but I'm going to deal with some of the biological urgencies that I'm feeling in the rant to the bathroom. He told reporters after his speech that he didn't have to take a bathroom break because he hadn't eaten since Friday and stopped drinking water on Sunday.
What?
To intentionally dehydrate himself.
Sounds like a new fad diet.
Yeah, anyway.
Wow.
Ask and you shall receive.
Okay, I mean, we were all wondering, weren't we? Thanks
There we
for the
go.
answer.
Anytime.
Appreciate it. Wonder if that's legit or not. Okay. Up next on the programme, Tariffs weighing on the outlook for the U.S. economy.
If we have a 20% tariff across the board, prices are going to go up. So that's disconcerting. We raised our inflation outlook for the rest of the year from 2 to 3% to 3 to 4%. And I think it's not going to be that transitory.
That conversation up next with Andrew Hollenhorst of Citi, live from New York. You're watching Bloomberg Surveillance. Don't miss this tomorrow morning, 8:30 Eastern Time. The Commerce Secretary, Howard Lutnick, live right here on Bloomberg Surveillance, responding to what's unveiled later on this afternoon at 4 p.m. Eastern Time. A major tariff push set to come from the White House. Live from New York City this morning, good morning to you all. Equity futures on the S&P 500 negative by 0.5%, a little bit softer across the board. On the Nasdaq 100, negative also. On the Nasdaq, we're down by, let's call it 0.6. Under surveillance this morning, tariffs weighing on the outlook for the U.S. economy.
If we have a 20% tariff across the board, prices are going to go up. So that's disconcerting. We raised our inflation outlook for the rest of the year from 2 to 3% to 3 to 4%. I think it's going to show up that quickly. And I think it's not going to be that transitory. It's not going to be 1 or 2 months. It's going to last for several months.
So here's the latest this morning. Uncertainty around President Trump's tariff agenda putting outlooks for the U.S. economy at risk and leading to downgrades across Wall Street. Andrew Hollenhorst of Citi joins us now for more. Andrew, good morning.
Morning, John.
Let's start with this first question just to frame things. First cut from the Fed. What are you expecting?
We have the first cut in May. That's going to depend on the next couple jobs reports. They have 2 more jobs reports before that. If they don't see enough weakness by May, then I think they're cutting in June.
Interest in your response. The next couple of jobs reports. I thought you were going to say it depends on 4 p.m. Eastern Time this afternoon. How important is that?
I think it's important, but I think Chair Powell kind of tried to pre-position for this. This is why he was talking about tariffs at the last FOMC meeting before the policy was out. He's kind of pre-committed that the Fed is ready to look through the inflation that we're going to get around tariffs, and that's why I'm focusing on the jobs report.
How unified is the Federal Reserve on that idea that this is transitory, any kind of inflation pop that we get from tariffs, given that you see a growing number of metrics that consumers see long-term inflation ticking up?
Yeah, not unified at all, to be frank. I think there's a range of views on this. We heard Chair Powell talking about the base case being that these tariffs would be transitory, that the inflationary effect of these tariffs would be transitory. And that is kind of central banking 101. You have a tax increase, you have a tariff increase. It's a one-time movement in the price level. Now, the issue is this is the same central bank, and it's part of a global network of central banks that talked about transitory inflation a few years ago, and that proved to be more persistent. So I think they really have to sell the story of inflation expectations being anchored. We're not seeing it in University of Michigan. You're seeing it in a lot of other measures, but not in University of Michigan. And that these tariff effects are just happening in goods. If you start to see the inflation more broadly in services, then the Fed's going to have a real problem.
You saw that in ISM manufacturing yesterday. To that point, you saw the headline numbers slip back into contraction at the same time that you saw a resurgence in the prices paid ahead of that tariff announcement. What is the liability, to Terry Wiseman's point, for the Fed to cut now and allow some of the price increases to become entrenched, and frankly, for growth to accelerate enough to keep inflation more entrenched, to keep it a more protracted reality?
So that's the real question. What it looks like is happening now, I mean, look at GDP in the first quarter. It looks like we're going to be flat or maybe even negative in the first quarter. And that's really before you had the effects of tariffs coming into the economy. So this looks like a consumer that's slowed down, an economy that's slowed down. If that's the case, you can be a lot more confident cutting rates. Part of the problem with transitory inflation a few years ago is we just had a super strong demand backdrop, and that meant that firms could push up prices. If demand is faltering here, even if tariffs go up, that means firms are going to have difficulty passing those price increases on through to consumers. I'm not saying that some of those price increases won't get passed through, but it won't take off as this kind of broader inflationary shock. So that's what the Fed has to negotiate here.
If the consumers push back and the companies need to make up money elsewhere, does that mean we're going to see layoffs from tariffs?
You could have layoffs related to tariffs. You could also just have firms that are compressing their profit margins. Not good news for firms.
You're one of the lowest in terms of the estimates for Friday when it comes to payrolls, 95,000. How much is that coming from the Doge effect in Washington?
We're getting some of that from Doge. If you looked at the JOLTS report, actually, we got a little bit of an early indicator of what that might look like. 22,000 layoffs in the federal government in that report. So we think we'll see some of those layoffs starting to show up. And even if you don't see the layoffs, just the fact that there is a hiring freeze that's happening means you won't have as much contribution from government workers. May, June, July, that's when you probably get more of a negative effect from Doge.
So, Andrew, this is the key question. The spread right now between the soft data and the hard data. Soft data's down here, hard data's down here. How's that spread going to reconcile in the months to come?
I think we're going to move more towards some of the weakness that we're seeing in the soft data.
Hard catch is down.
Hard catch is down, yeah.
Too early to see that on Friday?
I think it's probably early. We may see a little of it. We are below consensus on the jobs number, but I'd wait for these upcoming jobs reports.
What would you circle on the calendar as the key week, the key date where you may see this show up in a more profound way?
I'm really looking at the next jobs report. That's when we should see more of the Doge layoffs coming up. And also just remember, that's when the economy is supposed to be hiring a lot of workers, and it's still a low hiring rate economy.
The firm DataTrack came out and said this last night, that the fundamental strength of the U.S. economy over the last 4 years is largely due to employers being unwilling to let go of workers in the post-pandemic reality. They still see that being in effect today. Do you agree with that?
I think that still is in effect. Again, you can go back to that JOLTS report and you see a low hiring rate. So it's not that firms are excited about hiring people, but a low layoff rate. Firms have been reluctant to part with their workers. The concern is that is a fragile situation. If that layoff rate starts rising, well, then those workers are entering a labor force where there's not a lot of hiring going on. And we know the layoff rate is going to rise because some of those government workers are going to be laid off.
So we are expecting to get, at least according to the Atlanta GDP Now forecasts, it's actually negative for the first time going back to July of 2022, even when you take out the gold distortions. If we get another negative quarter, that is a technical recession. Could you get that type of scenario in economic growth in the U.S. without some sort of increase in layoffs, in unemployment?
Well, and this goes back to some of the soft data where you already see consumers, individuals that are becoming more concerned about getting a job, more concerned about losing a job. If that's already increasing and we're not seeing those layoffs yet, if you start to see those layoffs tick up, then you'll see more consumer concern, people pulling back more on spending. So I think it's very correlated. If the economy slows down, the unemployment rate will go up.
It's incredible to see this anxiety around unemployment in the sentiment surveys, with unemployment still around 4%.
You can see, though, the stagnancy that people have. You can see the fact that those who are touched in some capacity by the layoffs in Washington, D.C. are contractors with the government. It feeds to this narrative, at least, if not reality, that there is a job insecurity prospect that is different than the last few years.
Something Amanda Lynham of BlackRock has been thinking about, the interaction between tariffs, margins, and the labour market, the three things to watch in the coming weeks and months. Andrew, it's good to see you, sir, as always. Thank you. Andrew Hollenhorst there of Citi. Up next on the programme, here's the lineup for you. Mohamed El-Erian of Queen's College, Cambridge. The former Trump trade advisor, Kellyanne Shaw. We'll catch up with Seth Carpenter of Morgan Stanley and the former Obama economic advisor, Jason Furman. The second hour of Bloomberg Surveillance is up next.
A lot of challenges out there, tariffs being kind of front and center.
The market now is laser focused on this tariff or trade issue.
It's that consumer element that has changed that's giving us more concern, especially with tariffs coming.
This is a complete paradigm shift if those tariffs come in as expected.
We will get some clarity. The big question is, does the market like that clarity?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and we begin with some scores. Equity futures near session lows and negative 0.5% on the S&P 500. On the Nasdaq 100, softer also. Lower, negative and down this morning by around about 0.7%. Looking ahead to some economic data later on this morning, ADP employment change. But the big one comes later, 4 p.m. Eastern Time, live from the Rose Garden, a major tariff announcement.
And this is the expected opening salvo for negotiations. That's what Scott Bessent, Treasury Secretary, told to a number of Congress members who reported that. We heard from the spokeswoman, Caroline Leavitt, that Donald Trump likes a good deal. He is open to taking phone calls. Here is the state of play. Jordan Rochester of Mizuho saying if the effective tariff rate is 10%, risk rallies a good amount. Anything close to 20% or higher, risk sentiment a lot lower. So that seems to be how we're set up.
We're going to spend this morning asking, what are you expecting at 4 p.m.? And a lot of people are going to sit here and say, I really don't know. And good for them because they're being honest, because even people in the administration don't know what to expect at 4 p.m.
That's right. There's 3 proposals right now that is circulating the Oval Office. And if the president hasn't made a decision, then no one knows what he's going to come out with. I think the best way to think about 4 p.m. is we can have 2 paths. One is base case universal tariffs, whether it's 10 or 20% on every single trading partner, put up the wall around the United States, something the president promised to do on the campaign trail. The other is potentially more of a calibrated approach depending on each trading partner. The third option maybe is a bit of both. One universal tariff rate, much lower, not 20%, say 5 or 10%. He can assuage the concerns of his base, but then at the same time, look at some of the biggest grievances he has with some of the biggest trading partners and say, well, you might actually be in the end 25%, you might in the end be 10%.
So once you've figured that out, you need to figure out how everyone else responds to it. The Europeans, the Chinese.
And we're already hearing from the Chinese, they are going to at least begin to bar external investment by Chinese local companies in the United States. From Europe, they came out and they said that we will retaliate with everything. We've had Ursula von der Leyen talking about this. Again, how much is this positioning to get the best possible deal? And how much is this not being able to put the genie back in the bottle once you start with some of these tariff threats? And that, I think, is what people are worried about.
The retaliation and how these countries are dealing with it already taking shape. In Japan, the prime minister promised to set up 1,000 consultation booths around the country to help small businesses deal with these tariffs. You heard from Peter Tchir talking about this post in China about how China, Japan, South Korea are getting on the phone together, talk about supply chains, how can they retaliate. The Canadian leader with the Mexican leader talking about how they can maybe gang up in a sense and go against the United States. But depending on what happens, we need to wait until the president comes out and says at 4 p.m.
We mentioned this in the last hour, the $1 trillion judgment call for this market at the moment. This came from Julian Emanuel of Evercore. Is Trump going to use Liberation Day to score concessions from trading partners, or is President Trump willing to tolerate a near-term case of stagflation or even a mild recession to reshape the U.S. economy? That's the call this morning, and maybe for the rest of 2025 and beyond. Equity futures right now in the S&P pulling back by 0.6%. Your lineup looks like this. Mohamed El-Erian of Queen's College, Cambridge, on President Trump's major tariff push. The former Trump trade advisor Kellyanne Shaw on the president's ultimate objective. And the former Obama economic advisor Jason Furman on why the big bet on U.S. levies, quote, makes no sense. We begin this hour with our top story, the world awaiting President Trump's incoming tariff announcement. Bloomberg's Mike Shepard joins us now with the latest from Washington. Shep, that's what's amazing about this moment. We don't know, and apparently, Mike, based on our reporting, they don't know either.
They don't know either, and they are still deliberating over which path to take. And I think Annmarie outlined a really clear-cut set of options for the president and his advisors. But the question is which door and which path do they ultimately decide to take? And, of course, that opens up a whole other series of questions. How do these levies, when they're announced, fit in with some of the other tariffs that we've already seen the administration impose? On autos, those take effect tomorrow. On steel and aluminum, they've already kicked in. And then how about our other major trading partners, Canada, China, and Mexico? They're all facing levies over the fentanyl trade and immigration that Donald Trump imposed weeks and weeks ago, and that remain a sore point. It even came up overnight in conversations with China's foreign minister, expressing chagrin over those fentanyl tariffs, saying, look, if you want to talk about trade with us, those have to come off first.
Mike, when it comes to what the White House currently is thinking, this quote in Politico, Trump likes the shock and awe. Each country needs to panic and call. Trump wants to hear you grovel and say you'll cut a deal. When it comes to trading partners right now, where do they stand with maybe cutting a deal with this administration?
Well, it's a great question, and it really is the question of the moment. And it's a tough one to answer because we've seen the administration really take a much more elbows-out approach when it comes to long-time allies and trading partners, especially in Europe. The European Union is looked upon with some disdain by members of the administration who object to regulation, who object to some of the things like the value-added tax and digital service taxes that they see as trade barriers and trade impediments for U.S. exporters and U.S. goods. And likewise, in these other trading partners, they're also seeing impediments. For example, in Taiwan, Donald Trump has blamed Taiwan for essentially taking away U.S. manufacturing in semiconductors. So each of them comes with a bit of baggage that Donald Trump will keep in mind as he is negotiating. And they have tried to take, as we have seen already so far, a maximalist position. And whether they're willing to actually concede and conduct those negotiations in a good faith way remains to be seen.
Shep, looking forward to the coverage from you and the team throughout the day down in Washington, D.C. Mike Shepard there of Bloomberg with us around the table. Mohamed El-Erian of Queen's College, Cambridge for the next 2 hours. Could be a major day for financial markets worldwide. We've got one of the very best with us through the rest of this programme. Mohamed, good morning.
Good morning, John. Thank you.
Good to see you. Starting positions matter, so let's take a step back. Where we are right now. Have you ever seen sentiment this bad outside of a recession?
I have not. I worry about the soft data becoming market reality, becoming hard data reality. And I think that's the path we're on right now. And it's a path that has a strong whiff of stagflation.
Which raises the question, at what point can you feel like that worst case scenario isn't what's going to come to pass? What could happen that could make you think, actually, this is a rewiring of the global order akin to Thatcher or Reagan?
So think of what has happened in the last 2 months. In the last 2 months, we've gone from U.S. economic exceptionalism to stagflation. We've gone from Germany is stuck in a low-level equilibrium to Germany's Sputnik moment. We've gone from this is going to be a one-round rewiring of the global economy to this is going to be a multi-round rewiring. We've gone from the U.S. outperforming to the U.S. underperforming European equity by 17 percentage points. We've gone from a bond market that was worried about the vigilantes to a bond market that's torn between low growth and higher inflation. This has been an incredible transformation. Consensus is we're in an uncertain period. Where I think is a really important point is where is this leading to? And as you said, there's two possibilities. One, I call it the Thatcher-Reagan, where we go through disturbances, we rewire the economies, and we come out with a streamlined government, better debt dynamics, and an able private sector with major innovations coming up that can change productivity and a fairer trading system. That's option A. Option B is Jimmy Carter on steroids, meaning a stagflation that gets embedded in the system that paralyzes policymakers, and it takes a major slowdown in order for the policy stance to respond. I think it's 50-50. The market sees it as 80-20. And that's what we've got to figure out.
Wait, hold on a second. You think that the market is pricing in an 80% chance of the Reagan-Thatcher situation, of the best case scenario, and only a 20% chance at the same time that you do see this huge spread in performance between the U.S. and Germany. You do see such incredible entrenched pessimism in both consumers and corporate executives.
Market prices, if you look, what's happened to credit spreads, they've hardly moved. If you see equity, we're back to November levels. We haven't had it dramatic. What we have priced in is the uncertainty of the journey. What we haven't priced in is what I think is a 50-50 destination. That is what's going to sort itself out over the next few weeks and months. And I worry when I hear the Fed, when I hear Chair Powell at his last press conference dismiss the soft data as, oh, it's soft data, it's not going to get translated into anything worse. Bring in again the word transitory on tariffs. You've spent the whole morning saying the right thing. We don't know how other countries are going to respond. If you hear carefully what the president has been saying about tariffs, and you ask the question, how does he meet the multiple objectives he set out? He has set out revenue, he has set out onshoring, he has set out non-political, he has set out reciprocity and a fair trading system. What you end up with is option 3 for Annmarie, the hybrid approach, where you have a universal tariff across the board, Then you have surcharges according to sector, according to country, that are subject to multiple rounds of negotiation. Not one round, multiple rounds. If that happens, then the notion that the inflationary effects are transitory would be really good news, because we have a recent history of inflation and people will not dismiss it as quickly as the Fed seems confident that they will.
If we want to see potentially this Reagan-Thatcher constructive approach, what do you want to hear from the president today?
So it needs to be as far away from a spaghetti bowl as possible. Spaghetti bowls are really hard to unwind. That is why protectionism is so dangerous, is because it's so tempting to use a country-specific, sector-specific, and next thing you know, you cannot figure out where the distortions are in the economy. So if it is the Reagan-Thatcher moment, you need clarity on an across-the-board universal tariff. You need clarity on what's going to come on deregulation, because we haven't heard much on that as yet. You need clarity on what this public sector reform, are we remaking it or are we breaking it? That's a fundamental question about the public sector reform that we're seeing right now. You just need clarity. And that's why I put it 50-50. I was recently in a meeting with people I respect, and I forced them into these corner solutions. I said, here's option A, Reagan, Thatcher. Here's option B, Jimmy Carter. Give me probabilities. These are smart people. The range went from 80-20 to 20-80. That is the extent of uncertainty about the destination.
But you likely won't get clarity today if Trump wants to have negotiations and do deals. So what's your base case?
So my base case is exactly what you said, is that we're going to get option 3. Hybrid. But I must say, and I laughed when people said, I don't know. I put up something on social media today saying, every time I've been asked on this question, I've responded, I don't know. It doesn't stop people from asking me. So if you really put a gun to my head, I say, if the objective of the administration is to meet all these things with tariffs, then this is what you would get. That's the logic of the case. It's not a prediction, because I don't think anybody knows what's coming other than a very close circle around the president.
You've described the programme for the next 1 hour and 45 minutes. Looking forward to doing it with you. Mohamed El-Erian is going to be sticking with us. Equity futures at the moment, near session lows. We're down about 0.5% at the moment. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. A group of 50 bipartisan senators has introduced a new package of proposed sanctions targeting Russia if President Putin refuses to engage in ceasefire negotiations with Ukraine. According to a draft seen by Bloomberg, the sanctions include a 500% tariff on imports from countries that buy Russian oil and bar U.S. citizens from buying Moscow's sovereign debt. Meanwhile, Republican lawmakers are in the process of drafting a tax bill that includes raising the state and local tax deduction, known as SALT, to as high as $25,000. The cap applies to individuals and is currently at $10,000. The plan is being negotiated behind closed doors and is still being drafted. And RFK Jr. is making major changes at the Department of Health and Human Services. He cut 10,000 people from the organization, including those overseeing vaccine reviews, drug approvals, and tobacco regulation. Some entire divisions were gutted, including those working on sexually transmitted diseases, environmental health, and global health. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Appreciate it. More from Yahara later on this hour. Up next on the programme, tariffs incoming.
They will be effective immediately. And the president has been teasing this for quite some time, as you know. He's talked a lot about April 2nd as Liberation Day. It is going to work. We are focused on restoring the golden age of America and making America a manufacturing superpower.
So-called Liberation Day. Is it going to work? Up next on the programme, the former senior Trump trade advisor, Kellyanne Shaw, live from New York City this morning. Good morning. Two days of gains coming into Wednesday. Equities lower this morning by 0.6% on the S&P. We're down by 0.75% on the Nasdaq 100. Under surveillance this morning, tariffs incoming.
They will be effective immediately. And the president has been teasing this for quite some time, as you know. He's talked a lot about April 2nd as Liberation Day, but tomorrow will be the day, and he's been talking about it for a while. It is going to work. And the president has a brilliant team of advisors who have been studying these issues for decades. And we are focused on restoring the golden age of America and making America a manufacturing superpower.
So here's the latest this morning. President Trump's sweeping tariffs taking immediate effect after his 4 p.m. Eastern rollout from the Rose Garden. Today serving as the centerpiece of Trump's effort to bring manufacturing back to the United States and upend the global trade system. Joining us now, the former senior Trump trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the program. The press secretary says it will work. Our question is, what will work? What is the ultimate objective?
Well, good morning. As I'm saying to most of my clients, happy Liberation Day to those who observe. The truth is we don't know. And I heard your last guest say that he has said, I don't know, 17 times. And I think that's where most advisors are at the moment. It could be a number of actions. It could be anything from reciprocal tariffs, where a series of countries have a number that's assigned to them that represents their tariff and non-tariff barriers. It could be a global sweeping tariff, or it could be some mix in between.
Kellyanne, what is the goal of these tariffs? What is the president leaning on at the moment? Because we heard that they're supposed to be revenue raisers. And at the same time, in the next breath, we hear people from the administration say that he wants to cut deals with some trading partners.
Yeah, from my perspective, I think the president has two primary objectives. So first is to address the longstanding trade deficit, that $1 trillion trade deficit that the United States has with a number of countries around the world and predominantly coupled in about 15 economies. The second goal is really about just this uneven playing field. And when I was in the first Trump administration, I heard him talk about this all the time, the fact that it was just fundamentally unfair that other countries had higher tariffs than the United States. And so I think he's looking to level the playing field. Now, he does talk about revenue as well, but to my mind, that really is a secondary concern. And I think he's really going after the brass ring, which is to remake the global trading system and to rebalance it in a way that more accurately reflects U.S. interests.
If that's the goal, and having worked for him and being a trade expert, what do you think is the appropriate prescription we might get from the president today?
Yeah, I think that the president is likely, and again, I heavily caveat this with nothing is final until the president says it so. I think he is likely to target those countries that are the worst offenders in terms of tariff and non-tariff barriers. We may see a more global measure applied to the rest of the economy, but I think he's going to be focused on those handful of countries. And to my mind, this kicks off a negotiation. This is not the end. This is not the certainty that I know a number of businesses and the markets are looking for. I think this gives other countries an opportunity to come to the table and say, look, we hear your concerns. We will cut some of these barriers too. And that the United States and those trading partners on a bilateral basis would begin to reciprocally lower their barriers.
Kellyanne, one of the questions I get asked a lot outside the U.S. is how many rounds is this going to be? And at what point do we know that whatever we offer sticks? How should we answer those two questions?
Yeah, I mean, one of the features of President Trump's negotiating strategy and his style is ambiguity, and it is very rare to get that kind of certainty. But what we did see play out during Trump 1 were a number of deals that were cut and inked, including the NAFTA renegotiation, which became the USMCA. We saw the Chorus agreement renegotiated. There was a deal with Japan. There was a deal with China. So I do think that there is precedent for having that certainty at the end of what will be a rocky negotiation period. But I do think we're looking at the next several months to next couple of years with some of those trading partners before we actually get there.
Kellyanne, this raises execution risk, and people have talked about this repeatedly, that confidence among CEOs, CFOs, consumers has been falling off a cliff amid the uncertainty that may be a feature and may be prolonged over the next months and years. How concerned are you about this execution risk?
Yeah, I think two things are happening at the same time, and they're really in opposition to one another. On the one hand, the president is looking to reshape the global trading system, which requires breaking a lot of glass and not giving his bottom line. On the other hand, he's trying to attract investment from businesses around the world. And those two goals really require different strategies. So the administration is trying to land the plane on both. I think in terms of execution, the administration has an uphill battle. They're trying trying to do something that's never been done before. They're also trying to message this to the American people. And I think that whatever President Trump says at 4 p.m. today will be one of the most consequential speeches of his presidency, because he's effectively going to ask the American people for a long leash to allow him to negotiate some of these deals and fix some of these systemic issues. So we'll have to see how this plays out.
The press secretary said that some of these tariffs will be effective immediately. So do you expect tariffs using IEEPA or Section 338 to come out today and begin tomorrow?
Yeah, I think there are 3 types of legal authorities the president can use to impose tariffs effectively immediately. So IEEPA is one, Section 338 of the Trade Act of 1930 is another, and then there's also Section 122 of the Trade Act of 1974, which is about balance of payments. So he'll certainly have to rely on one of those. I don't know which one the president is going to use. I tend to think it might be IEEPA, but any one of those authorities would give him the ability to impose tariffs right away. Now, I will be looking to see what the executive order actually says, and whether by immediately that means exactly at 12:01 on April 3rd, or whether there are a couple of days to give importers some grace, or even a ship on the water exception, which is what we saw in the fentanyl tariffs.
I'm just pleased the announcement comes after the close now, and not the original 3 p.m. that Secretary Besson guided us towards. Kellyanne, appreciate your time, as always. The former senior Trump trade advisor, Kellyanne Shaw. By definition, and we've said this a million times, by definition, the importer pays the tariff. How the cost is distributed is going to be up for debate, not just today, but for months and years to come. Mohamed, some things can guide us towards an understanding of how the cost will be distributed. One is where margins are right now. Another dimension of this conversation would be, what is the consumer price tolerance right now for higher prices? How is that guiding you in your thoughts about how those costs will be divvied up amongst this economy?
I suspect it's going to be sequential, John. Round one is going to be try to pass as much as possible to the consumer, and not just on new inventory, but on existing inventory. Ask the question, if you are running the BMW dealership, how are you going to differentiate between a car that's come in after the tariffs are implemented or before? You will somehow average it out and change the pricing for your whole stock. So we're going to see some reactive price adjustment. We're going to see some preemptive price adjustment. That's round one. Then round two will be, can demand support this? And that's where it gets really interesting.
It's where it gets really tricky. And the response we've had, Lisa, over the past few weeks is perhaps not.
Well, and this to me is the key question also. How much does it consolidate power among some of the biggest companies out there? I'm thinking of the Walmarts and some of the ones that have the power to negotiate lower prices and jawbone that down. Smaller businesses, how much do they get hit even harder if they are unable to pass along those price increases? We've already seen that to some capacity, but that to me is what I'm watching.
Walmart's a great example. What Walmart is doing is what the president wants to see, which is go back to the exporter, go back to the supplier and renegotiate. Not everyone's Walmart.
Not only is not everyone Walmart in terms of size, but not everyone's Walmart in terms of the leverage that they hold in China, where they have Sam's Club, which has great meats, I hear, and lots of different produce that a lot of people love. So they have that clout to be able to not be as worried about the retaliation on the mainland to a possible negotiation.
Who's told you that? Where are those reviews from?
I've seen multiple. This is with my also Cory Booker bathroom experience.
Okay.
I have all sorts of news you need.
Don't want to see what's on your dashboard. Coming up on the programme, Seth Carpenter of Morgan Stanley. As uncertainty is weighing on global growth, just what is on the Lisa Abramowicz Bloomberg launchpad? Who knows? Futures negative by 0.5% on the S&P from New York. This is Bloomberg. Live from New York City, welcome to the programme. Long trading day ahead of us. And then after that, you've still got payrolls on Friday and an address from Chairman Powell going into the weekend. Equity futures on the S&P near session lows. We're negative by 0.6%. On the Nasdaq 100, we're down by 0.75% with 2 hours until the cash open. Here are your morning movers with Yahara Hacker. Say Yahara.
Hi, John. We start with a check on Tesla, falling 2.6% here. Even ahead of those delivery numbers expected later this morning, we already have some news. Preliminary data by China's Passenger Car Association showed Tesla deliveries saw a huge drop in the month of March, falling 11.5% year on year to about 78,000 units, so it's still struggling in China amid fierce competition there. And next up, we get a check on Newsmax. Shares are falling 23%. The stock is having a meme stock moment, but today it's giving up some of the gains we've seen. The stock IPO'd at $10 on Friday. Now it's still a $178 stock, and it has a valuation greater than its conservative news rival, Fox. So very notable. Next up, we have Hims and Hers. That stock is falling 5% after initially popping on the news that it would begin offering access to brand name weight loss shots like Zepbound. But analysts say they don't think this is going to get a lot of traction because the cost is just too high. Hear this. A monthly prescription for Zepbound on Hims will cost $1,899 a month, which is $800 more than what Eli Lilly charges. John?
Yahira, thank you. Appreciate the update. 3 names to watch going into the opening bell. On our radar this morning, our top story worldwide. President Donald Trump's tariff plans coming down to the wire. Sources telling us here at Bloomberg that Trump's team is still finalizing the approach ahead of today's Rose Garden event at 4 p.m. Eastern Time. Elsewhere, President Trump also meeting today to discuss the sale of TikTok's operations in the United States. People familiar with the talks telling us that Trump's considering a deal with Oracle and Blackstone. TikTok facing a deadline to find a buyer by Saturday.
So I'm not surprised that Oracle's involved with this. No U.S. company is more intertwined with TikTok than Oracle has been when it comes to cloud and Project Texas to try to cipher off some of the U.S. data. The deadline is Saturday. Now, Trump has said he could extend the deadline. He's also talked about the fact that he might use TikTok when it comes to negotiations on tariffs with China. So it sets up a really interesting day of the fact that he's going to have this meeting today with his Vice President J.D. Vance and some other officials that are dealing with national security and TikTok, like Tulsi Gabbard and Mike Waltz. But then on Saturday is the deadline, and at 4 p.m. in the middle of all of this, he's announcing tariffs.
Throw in our reporting earlier on this morning, Lisa, that China has taken steps to restrict local companies from investing in the United States.
It's a great point. Will China sign off on this, given the tit for tat, given the backdrop? And then, and this actually is my ultimate question, how much is President Trump willing to go through with this ban if China is not willing to allow TikTok in the U.S. to be sold to one of these U.S. investors? One of these key moments to test how much actual resolve there is in the White House.
There's an extra wrinkle in the story. You've all been following it, I'm sure. The Hong Kong conglomerate CK Hutchinson that we thought had a deal led by a consortium, led by BlackRock, to sell 2 of the ports down in Panama. And now we understand the Chinese government might have other thoughts on the matter.
The Chinese government went to them and said, you didn't ask us for the permission to sign off on this kind of deal before you actually transacted with it, and now it's being held in limbo. Again, it raises the question, what incentives does the Chinese government have to allow some of these sales to go through at the same time that there's been some pretty harsh rhetoric from the White House? How does that get executed in terms of action?
Beijing is going to use the leverage they have right now, especially when, remember, when it comes to tariffs that are in place since Trump walked into the Oval Office, we're seeing an additional tariffs on China that actually stuck. One thing when it comes to TikTok, and you talk about potentially how this dance will go with China, Oracle would provide security assurances, according to our reporting, while potentially leaving the app's valuable algorithm in Chinese hands. Now, will that satisfy the law that Congress talked about, the fact this was a national security concern, but that's potentially one way they could get an end to this deal and keep TikTok in the United States operating while still getting around the fact that ByteDance needs to maintain control.
I can think of 3 deals right now that have massive national security elements to them and huge government involvement. One is TikTok, the other is this one with CK Hutchinson, and the third is Nippon Steel. The Commerce Secretary, Howard Lutnick, fielding rival offers for U.S. Steel. People familiar with the matter telling Bloomberg that Lutnick held back-to-back meetings with Nippon Steel, an activist shareholder, and Cura Holdings.
So I guess if you up the ante on the price, maybe it's more acceptable. Nippon Steel, we are reporting now, is willing to invest an additional $7 billion to complete the $14 billion takeover. I am old enough to remember when the President of the United States was campaigning and said, I am, quote, totally against the once great and powerful U.S. Steel being bought by a foreign company, in this case, Nippon Steel of Japan. Well, maybe now he's in office, there's not an election, Pennsylvania's one and done. they can move on.
Things can change in Washington, D.C., which makes this afternoon rather complex at 4 p.m. Eastern Time, because things can change in the hours, the days, the weeks, the months and the years after that. If you are just joining us, welcome to the programme. Equity futures here down by 0.6%. Markets speculating on the details of President Trump's tariff plan. Seth Carpenter of Morgan Stanley writing, our base case remains that the focus of US tariffs will be on China. But if trade tensions escalate beyond our base case, the drag on corporate confidence, on capex and the business cycle will intensify. Seth joins us now for more. Seth, welcome to the programme. It's been too long, my friend. Let's talk about later at 4 p.m. Eastern Time. And I think more importantly for a lot of people in this market, how is the Federal Reserve going to navigate this moment?
It's great set of questions, Jonathan. And it's, I think, the set of questions that just about everyone in markets is asking. First, the uncertainty here is huge. We've heard some more commentary out of the White House where they're clearly still resetting what they're going to do with tariffs. And so I think even inside the administration, there's some uncertainty yet. The Fed is left in this truly difficult circumstance where tariffs very clearly seem to push up price levels, which should boost inflation as reported in the CPI, all the regular data. My base case, as is the Fed's, is that inflationary boost is going to be temporary and should fade over time, but I don't think is going to be good enough for the Federal Reserve. I think it will be very hard for them to say, wow, this inflation will go away. I know because of my models that growth is going to take a big hit in 2 quarters or maybe into next year. So let me cut interest rates now, despite inflation heading back up towards 3%. I just don't see them doing that. And so I think they're going to have to wait. Once we see inflation from tariffs start to kick in, they're going to wait on the sidelines with policy in their minds in restrictive territory and see how the tariffs play out through the economy. They're going to believe they'll be temporary on inflation. They're going to want that confirmed in the data. They're going to believe that it will cause the economy to slow down. But until they start to see it in the hard data, and make no mistake about it, the market has got the right answer here about a slowdown, but I think for the wrong reasons. There's not a ton of hard data yet that reveal the slowdown. I think all of that is still in the offing.
So it sounds like you don't really see a Fed put in the offing to try to really give a boost to both economic growth and confidence in markets, which raises the question about a policy put on the other side. What is currently being priced in? We were just talking with Mohamed El-Erian, who is here, and he said that he sees it as a 50-50% chance of a Reagan-Thatcher reordering of an international trade versus Jimmy Carter on steroids. Markets currently pricing in about 80-20. What do you see?
I mean, I think it's very hard. When I talk to clients, investors around the world, there are as many views there as there are investors that you talk to. And so I think you can see the same asset pricing reflecting multiple different narratives. I think people just don't know. And so I don't think you can take anything for granted from asset pricing right now. I think it remains to be seen. I think the escalation scenario where the U.S. imposes some tariffs and then other governments impose retaliatory tariffs, and then we escalate from there, that really is a potential massive shift. And I don't think, as some people have said, it's just a question of near-term pain versus longer-term gain. I think if you get that escalation scenario, then you're just talking about fundamentally less productive economies around the world. It's not a zero-sum game. It could actually be a net loss for the whole global order.
Seth, let me put you on the spot, if I may. On Sunday, one of your competitors came out and they had 3 elements to their new forecast. 1, PCE inflation from 3 to 3.5% for the year. 2, fourth quarter on fourth quarter growth down to 1%. 3, the Fed cuts not twice, but 3 times this year. What do you agree with? What do you disagree with on those 3 elements?
Yeah, so I think the main thing I would disagree with a bit is the timing. So we've got 1.5% as a baseline growth rate, but boy, lots of room for downside there. And that's a pretty conservative assumption on things like where tariffs go and how much this immigration restriction, which we should have a whole conversation about that. I think it is the most underappreciated policy from a macro perspective. But so 1.5%, 1%, I think both of those are very, very plausible. Direction of travel is just down for growth. Inflation higher from here. I think that's right. Our point forecast is a bit below 3%, but I can't rule out the higher number you cited. And for all the same reasons, tariffs could be stronger than we think. We could get more immigration restriction. I think the key difference for us is the Fed is in a very difficult situation. Data for U.S. economic activity lag. the Fed is going to have to pay attention to both inflation and growth. And before they start to cut in response to the slowing growth, they're going to have to accumulate enough information that says very clearly growth is a much bigger problem than inflation. That is very hard to do with inflation bottoming out and starting to rise back up, especially if it gets past 3%. I think you really need much more accumulated softness before Jay Powell and company are going to be ready to look through 3% or higher inflation.
Seth, do you see the market then as being wrong, pricing in 3 cuts by the end of this year, increasing that chance as the chance of some sort of weakening does seem to rise?
I do think so. I mean, the market has to price things on a probabilistic basis, and so there are lots of different scenarios implied in that price. I would say if you're relative to a straight reading of where the market is, they have too much priced in terms of cuts this year, nowhere near enough priced in for next year.
Seth Carpenter. Seth, appreciate your time. Thanks for making time for us this morning. Seth Carpenter there of Morgan Stanley. Thank you, sir. Going to take your question and throw it back at you. So Goldman Sachs, Jan Hatzius, let's give them the shout out over the weekend. GDP 1%, PCE 3.5, 3 cuts from the Fed. What do you disagree with?
The 3 cuts from the Fed. I think this Fed may deliver 1 because it's inherently dovish, but even 1 is going to be tricky with PCE inflation going up as it is. You know, if this was a normal Fed, which it's not, but if this were a normal Fed...
What's a normal Fed?
A normal Fed is a Fed that realizes that when the inflation genie is out of the bottle, and when you have a recent history of inflation, you've got to get that inflation genie back into the bottle. It would be a Fed that's getting us to speculate when's the next hike. That would be a normal Fed, but this is not a normal Fed. This is a Fed that's willing to dismiss the soft data too quickly, is willing to call tariffs inflationary impact transitory before we even know what's coming. So it's not a normal Fed. It's a different Fed.
When you say it's not a normal Fed, do you mean it's not a normal Fed chair? Do you hear that across the committee from all participants?
It's very hard to disagree with the chair. It's very, very hard. And that's why the Bank of England gets over this issue by having external members. External members do not feel that they are under the same constraints as internal members. So it is very, very hard to disagree with your chair on a consistent basis.
There also seems to be a shift in mentality, and I've spoken to a number of Fed members who are very concerned about the entrenched and long-lasting effects of an unemployment rate that rises significantly. And that it seems like there is an emphasis on preventing the scarring in an economy from that kind of unemployment pop that leads to longer-term earnings declines, et cetera. And so it seems like there is a fear of allowing them to be so late at the same time that people are saying you need to be late in order to get the inflation genie back in the bottle. And that, to me, feels like one of the key tensions.
You're absolutely right. And we're going to figure it out. But history is very clear on this, is that if you are facing stagflation, dealing with the deflation side comes first, and then dealing with the stag side comes second.
Mohamed, it's good to see you. You're going to be sticking with us, I'm pleased to say. Equity futures right now in the S&P negative by close to 0.7% with an update on stories elsewhere. With your Bloomberg Brief, here's Yahira Hekes. Hey, Yahira.
Hi, John. Walmart is continuing to push Chinese suppliers to slash prices to offset Trump's tariffs. Sources telling us here at Bloomberg, the company is still asking for 10% price cuts for each round of tariffs, even after government officials summoned Walmart executives after they caught wind of this. Meanwhile, President Trump has said for months that the U.S. will take over Greenland. Now that rhetoric may be turning into policy. According to the Washington Post, the White House is drawing up a cost estimate to take over the Arctic territory. The report says one option being considered is to offer a sweeter deal to Greenland's government than Denmark. And U.S. Attorney General Pam Bondi has directed federal prosecutors to seek the death penalty for Luigi Mangione. The 26-year-old is accused of murdering United Health executive Brian Thompson outside a Midtown hotel in December. Mangione is set to go on trial for murder in New York State, which hasn't executed a felon in over 60 years. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. Up next on the program, reshaping the global landscape.
Now you're seeing a shock that's internally generated inside the US. It's leading to US underperformance. We are undergoing transformations to international relations and geopolitics that we haven't seen for many, many decades.
In just a few moments' time, we'll catch up with the former Obama economic advisor Jason Furman from New York City. You're watching Bloomberg Surveillance. couple of times for the next 24 hours. 1, 4 p.m. Eastern time from the Rose Garden. You know that. The address from the President of the United States unveiling the tariffs we've all been waiting for. Tomorrow morning, here's another one. 2, 8:30 Eastern time tomorrow. Reaction from the Commerce Secretary, Howard Lutnick. A conversation you do not want to miss. In anticipation of these tariffs, we have seen GDP cuts across Wall Street from just about everyone. Mohamed mentioned Goldman Sachs down to just 1%. We've had price target cuts on the S&P from SocGen, Ed twice, Goldman twice, RBC and Barclays. This morning we're down by 0.6% on the S&P. We're down by 0.75% on the Nasdaq 100. Under surveillance this morning, reshaping the global economy.
In all these global shocks we've seen, if you think about COVID, if you think about the Russia-Ukraine crisis, the US has outperformed. It's been less exposed. So now you're seeing a shock that's internally generated inside the US. It's leading to US underperformance. We are undergoing transformations to international relations and geopolitics that we haven't seen for many, many decades.
So here's the latest this morning. Uncertainty around President Trump's tariffs threatening to undercut US exceptionalism. The former Obama economic advisor Jason Furman writing in the New York Times, where economic relations go, political relations will follow. This week's tariffs are another step towards hurting the US economy. I'm pleased to say that Jason joins us now for more. Jason, welcome to the program, sir. When you write the book, if you write the book, in 10 years' time, will today get its own chapter?
It probably will. I mean, you rarely see economic policy just turn on a dime and the economy turn on a dime. But that's what we've seen in a very, very short period. A big deterioration in confidence, a big increase in uncertainty, and a big change in the outlook for the economy.
Jason, do you think trading partners would be willing to unilaterally lower their trade barriers without the president taking these kind of approaches?
What trade barriers? I mean, we have trade barriers. They have trade barriers. If we all want to lower them together, it's called a free trade agreement. I'd be way for that. But average tariffs in Europe are 1 or 2% on the United States. Average tariffs in the United States are 1 or 2% on Europe. We had, during the Obama administration, been negotiating a free trade agreement with Europe. I'd be thrilled if the Trump administration wanted to revive that. That doesn't appear to be what they're doing, though.
There's a feeling that maybe this actually is all leading up to widening the division between the U.S. and China, which is a bipartisan type of outcome. Some people, including Peter Tchir of Academy Securities, was saying right now it's kind of doing the opposite. You're seeing China actually get closer to a number of former trade alliances. How do you see some of the geopolitical rearrangement that's already happening versus what could or would or should happen?
Look, the United States is a big, important country. That gives us leverage in the world, but we are not infinitely big and not infinitely important. We really need allies if we want to succeed. The majority of countries in the world, their main trading partner is China, not the United States. If you made them choose, I'll bet they would choose China over the United States. The only way we can deal with China is to work together with the rest of the world, and that just doesn't work if you're putting tariffs on the rest of the world and driving them closer to China. Makes no sense as a geopolitical strategy.
So, Jason, take us forward. What do you think the Fed will do, and what do you think the Fed should do when it wakes up and we've implemented tariffs across the board?
Look, the Fed has no choice at this point but to be behind the curve. A rising unemployment rate says cut rates. Rising prices says raise rates. Is that price increase temporary or permanent? Is it being built into expectations? They really have to wait and see, and cannot afford to act proactively when so many different variables are moving in different directions. And that itself is a bad place for a central bank to be. But that's where they have to be, given that we started this with high inflation and we have a very complicated shock hitting the U.S. economy.
Just to build on that, there are a lot of unknowns. There are more unknowns than I could ever imagine. At the same time, there are a couple of sort of knowns that people are putting out there, that the Fed is destined to be light, to look for the hard data to really confirm some of the weakness, and that you are seeing sentiment shift lower significantly in corporations and consumers. Based on that, how likely is it to reverse those realities versus project those realities out into the future in terms of reducing economic expectations and increasing inflation?
Look, I think we're going to see slower growth. I think we're going to see higher inflation. I certainly don't think the Fed should even be contemplating an interest rate cut until the unemployment rate is 4.5% or higher. And, by the time the unemployment rate is 4.5% or higher, it might even be too late. But there's not really an option to get ahead of this when we also have seen inflation expectations rise. So it's not just inflation, it's inflation expectations. I know people say this is one-time inflation. In some sense, all inflation is one-time. The 2021, 2022 inflation, that was also one-time inflation. That doesn't mean you can look through it and not react.
Jason, do you think there's a chance we could see the tariff inflation, which the Fed has called transitory, move to other things that are not just goods, services like haircuts?
Yeah, absolutely. I mean, first of all, some services like auto insurance depends on the price of autos. So there's some direct pass-through of tariffs to some service prices. But we've seen inflation expectations rising. When prices are higher, workers are going to demand higher pay. There's certain businesses that are going to be willing to pay them more because of their higher prices. And that sets that wage price cycle in motion. That's what higher inflation expectations are. That's how they show up in inflation. And that's a real risk. And remember, we started all of this with an inflation rate above 2.5%. Before the tariffs even came into effect, I was worried about a no landing situation continuing.
Jason, appreciate your time to break this one down ahead of what could be a major announcement later on this afternoon. Jason Furman there, the former Obama economic advisor. I guess by definition, everything is transitory if your time horizon is long enough, but no need to get philosophical this morning. Mohamed, the takeaway from that conversation appears to be, once again, the Fed is destined to be late. This goes back to how we are all thinking about this moment with regards to the Federal Reserve. Can they look through this moment, or will they have to react?
I think Jason put it really, really well. I think that he said the Fed has no choice. He also went and said the Fed shouldn't even be contemplating a cut right now. And I think he's right. But that's not what the market is. So the market believes that there's a Fed put out there. And we're going to have to work that out in the next few weeks.
It was the big takeaway from the news conference with Chairman Powell just a number of weeks ago, Lisa. We talked about it repeatedly. This market enjoyed the reality conveyed by the Federal Reserve Chair that higher inflation wouldn't mean higher interest rates. The problem we might have in the months to come is this market ready to embrace the idea that lower growth won't mean more rate cuts. That's the tricky situation we're in through the rest of 25.
Based on pricing, this market's not ready for that. Let's see what happens when you start to get more rhetoric, like Friday after the jobs report.
Straight after Chairman Powell addressing this global economy going into the weekend following payrolls and a big address from the President of the United States. Up next on the programme, Binky Chadha of Deutsche Bank, Tom Fitzgerald of TD Cowen, Julia Coronado of MacroPolicy Perspectives, and Matt Diczok of Merrill and Bank of America Private Bank. From New York, this is Bloomberg.
Wednesday will be big. What we really want to focus on is what's known versus unknown.
It's been incredibly clear what the Trump administration is trying to do. How much disruption are they willing to tolerate?
What we know about tariffs is tariffs increase costs. How much they increase consumer prices remains to be seen.
Tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect.
I don't think these worst-case outcomes are coming to pass.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell, with equity futures declining by 0.75% on the S&P 500. On the Nasdaq 100, a little bit lighter, softer, negative as well. We're down by 0.9%. In 15 minutes' time, you actually get some economic data. Is anyone going to look at it? ADP at 8:15 Eastern Time, because the big one's taking place at 4 p.m. An address from the President of the United States.
It's a great question at a time when people are pricing in 3 rate cuts by a Federal Reserve, more than 3 rate cuts by the Federal Reserve, even though an increasing number of people say this is a Federal Reserve destined to be late. Will the ADP move the needle? Will the jobs report that we get on Friday move the needle? It is hard to see how this market responds well to the idea that the Fed is not going to be reacting in any material way to weakness.
And a lot of this anxiety is coming from the White House. Kellyanne Shaw, who worked in Trump 1.0, as a trade negotiator, she did phase one trade deal with China. She says ambiguity is part of the process, which is why we are talking about today at 8 a.m., 8 hours before this announcement, about the three potential paths the president can take, whether it's universal tariffs, a tiered approach, or absolute reciprocity when it comes to trading partners.
Annmarie, you know better than this, than everyone sitting around the table. Usually a Trump White House is very leaky. Usually ahead of time, you've got a decent idea of what you're going to hear from the President of the United States. This time around, it seems like investors and officials, even officials in the White House, don't have a clue.
Because I don't think they've made a decision. That is what we are hearing. They have not made up their mind. And there are some leaks. You see it in the Wall Street Journal. You see it in Fox. You see it at Bloomberg. I think what you see is rival factions within the administration pushing for what they think should be the appropriate response to all the grievances the president has. And that's part of the problem. What is the solution he is trying to solve with today with these tariffs? Is it full reciprocity when it comes to trade? Is it to have better deals, so become a negotiation? Or is it really to raise revenue to offset the rest of his agenda when it comes to taxes in Congress?
So what do you hear at 4 p.m.? How do other countries respond to it? What do companies do? What do suppliers do? And can consumers tolerate it? All the kind of things we've got to consider for the next few weeks and months.
Yeah, and do they have something concrete to really discuss? Meanwhile, people are coming up with concrete responses in markets. I keep going back to Jordan Rochester of Mizuho because he came up with a really nice flow chart of what you should do in each scenario. Effective tariff rate of 10% equals a risk rally is a good amount. Effective tariff rate of 10 to 15%, risk rally slightly, but basically status quo. 20% or higher, forget it, all bets off, stocks down. And at a certain point, you have to imagine that's going to be the knee-jerk reaction.
Sounds like a Goldilocks bedtime story or a nightmare, depending on what you want to see a little bit later.
Are you creeping and listening to my household bedtime stories?
Is that when you read the kids at night?
I tell them, let's talk about tariffs.
I'm sure you do. Everyone believes you.
Actually, to be completely honest, we were discussing tariffs last night, and someone said, "What's the point?" And I said, "Good question."
Did you answer it?
I did. I started to lay out some of the points. We don't need to discuss this anyway, but it was great. Very educational.
I'm not surprised. No one is. Equity futures right now. Session lows. We're down by 0.8% on the S&P. Coming up this hour, Binky Chadha of Deutsche Bank on why he's still bullish. Tom Fitzgerald of TD Cowen on how trade tension is shaking up air travel. And Julia Coronado of MacroPolicy Perspectives on the chances of a U.S. recession. We begin this hour with stocks edging lower ahead of President Trump's tariff announcement. Binky Chadha at Deutsche Bank writing, a credible relent on trade policy is necessary for upside risk to materialize. The clock is ticking. Binky joins us now for more. Binky, good morning, sir.
Good morning.
You're still at 7K year end.
Year end is a long ways out.
I agree.
I would just like to.
But if you're still at 7K,
I would just like to correct the record that I am not bullish near term. We expect basically the sell-off to continue.
Still bullish year end.
That's 9 months out. It's 3 quarters out. If you think about what happens if we have sort of a mild recession, let's say the second and the third quarter. The tried and tested equities playbook would tell you that equities bottom in the middle of the recession. So that would be June 1st, recoup all of their losses. And that means at the prior peak by the end of the third quarter.
Just to be really clear, you think this year we could have a recession and still end the year at 7K?
I do believe so if it's a mild recession. That's actually what typical playbook would tell you. So where I would say, the pushback in your tone is really, are we just going to have a 2-quarter recession? Are we going to have a recession?
Well, to be fair, for somebody who comes out and has a 7,000 price target at a time when everyone's downgrading it below 5,500, and you say, well, I'm not bullish, everybody else would look at it and say, you're pretty bullish.
So we already at 5,600, so we're going to stay here for 9 months. The equity market's not good at staying in the same place, though I would point out that in Trade War 1.0, the equity market went nowhere, and neither up nor down, huge moves, but nowhere for 18 months, actually. So we are very well aware of that period, and it does play into how we think about things.
Is this predicated on the idea that some of the soft data is not going to be predictive of hard data, and that potentially you get some resolution in the near term, some clarity on policy, and potentially a Federal Reserve that helps out?
I would say not quite. What I would say is actually there's two distinct sources of basically soft data. I would say the low consumer confidence is not necessarily very predictive for what consumer spending and the business cycle is going to do. But consumer confidence is extremely important for presidential job approval ratings. And after an initial honeymoon period, job approval ratings tend to go down to consumer confidence. And, the way I would just note or remind is consumer confidence is exactly where it was when President Biden left. And so there's a lot of room for us to go down, and we would go down on bad growth news, bad inflation news, political developments. Now, I would say the other part of the soft data, which is CEO confidence, is extremely important driver of the actual hard corporate data and indicative of it. Now, CEO confidence is tier 2 data, so we don't have very regular reporting and the like. But there are some measures that have basically fallen off a cliff. I mean, we're now below 2022 levels on the CEO magazine. We are European financial crisis 2012 levels. Whether that translates to a good and comprehensive measure of CEO confidence remains to be seen. The measures all generally move together. So there's every reason to believe it, maybe not the extent and degree, but I think the biggest risk here is corporates go right back into the bunker. And once they go back into the bunker, they don't come out very quickly. So,
what policies in Washington do you need to see to get to your year-end target?
That basically the tariffs are, in negotiation, a relent, just as happened in Trade War 1.0.
And you think it's wrapped up in 9 months?
I think, if there is a relent or rationality, if you want to call it that, we could get there pretty quickly. So
Binky, I want to take you away from your 7,000 target and ask you the question.
December 31st at 4 p.m. Yes, yes.
Yes. Over the last quarter, the S&P has underperformed the Euro Stoxx 600 by 17 percentage points. Which is remarkable. Some people think this is just the beginning, that we are going to have a normalization of valuations over the next few quarters. Some of it think it's overdone. Where are you on this?
We think it's got a long ways to go, basically. And really the issue is whether Europe can grow. We have, again, the cross currents that we've been talking about. We have the tariffs, as the negative. But, if I look at Eurodollar, I mean, it's sitting right at 108, which is a very reasonable place to sit. So
if you believe that...
If growth starts to pick up, and I would say the ingredients for growth to pick up in Europe were already basically there before all of the German developments. So the German developments, are another positive and another reason to believe that growth will come. And if growth comes, we will get the earnings, and that's all that you basically...
But isn't that a problem for your S&P 7,000? Isn't that a problem that some of the oxygen now gets sucked out by Europe? Flows are no longer persistently to the US. The US no longer sucks up global capital, and you lose a critical technical that has supported your bullishness about the S&P. Isn't that an issue for you?
At the margin, yes. But I mean, right now, what I would do is I would be overweight Europe, which is what we are, and I would also overweight the U.S. I mean, remember that we're already down, around 8%. So it is looking better. And if you look at relative performance, tends to form in a channel. We have just moved from the U.S. relative to Stoxx 600. We were at the tippy top. We are now exactly in the middle. That's why I say, we're just about
What are you underweighting? There. So you're overweighting everything. What are you underweighting?
No, I'm just looking at, that was about the S&P relative to Stoxx 600. In local currencies, we are right in the middle of the channel. So there is more room for the U.S. to underperform without really changing the trend. And so what has happened so far, the 17 point, that's half of, we're in the middle of the channel, so it can continue without basically upsetting the channel. But for the channel to continue, or for the channel to break, it's really about whether European earnings start to grow.
For as long as I've known you, for a long, long time, you've been bullish and right, and I've been skeptical and wrong. But this is the most bearish 7K conversation I've ever heard in my life.
Yeah, I'm glad you didn't ask me what my 2026 target is.
What's your 26 price tag?
No, I don't have one. So.
What gets us to 7K in the United States?
Look, the economy is still in good shape. We are closer to the edge. The risks have grown. There's no question about it. And there's no obvious large, big imbalances outside the U.S. government, I would say. And so it's all very possible. But yes, we are getting close to the edge, and the risks have gone up a lot.
So what would make you turn bearish?
No relent on trade. Trade policy continues the way that it is, and just general lack of clarity in policies. I mean, what I'm saying is, if policy stepped out of the way, the equity market and the economy would be just fine. It is policy that is the big negative right now.
Is there a statute of limitations where there needs to be some clarity, before which the damage becomes more entrenched and you have to start to model it out?
That's exactly right. Yeah.
What is that statute of limitations?
That statute of limitations is once we get to a point in this slowing that potentially non-linearities start to kick in. I mean, if you look at the labor market in the U.S., it's a pretty delicate balance. I mean, it's been very, very steady, so I'm not sure delicate is the right word, but it is delicate behaviorally. It's just been stuck right there for quite a while in terms of hiring rates and firing rates. Both are at very, very low levels, so it is kind of stuck.
Binky, you're a good sport. It's good to hear from you, as always. Thanks for catching up with us. Binky Chadha there of Deutsche Bank. Still looking for 7K year-end on the S&P. Equity futures right now in the S&P, negative by 0.8%, with an update on stories elsewhere. With your Bloomberg brief, let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. China is restricting local companies from investing in the U.S. According to people familiar, several branches of China's top economic planning agency have been told to hold off on registration and approval for firms looking to invest in the U.S. The decision does not appear to impact existing commitments or China's purchases of U.S. financial products. Meanwhile, Manhattan home sales surged in the first quarter, up 29% from the same period last year. Buyers are taking advantage of small dips in mortgage rates, with 42% of sales financed. Luxury deals also showed strength, with the median price climbing almost 19% last year to $6.87 million. And movie star Val Kilmer has died. Kilmer came to fame playing Iceman alongside Tom Cruise in 1986's Top Gun. He was also well known for his roles in Tombstone, Batman Forever, and The Doors biopic, in which he played Jim Morrison. Kilmer was 65 years old. That's your Bloomberg Brief. John?
Yahara, thank you. Absolute legend. Appreciate it. More from Yahara later on this hour. Up next on the programme, the Morning Calls Plus. Breaking data from ADP. ADP employment change with Mike McKee in just a moment. And reaction from Mohamed El-Erian. The number we're looking for, 120K. The previous number, 77. The actual number drops next. The opening bell is 1 hour and 13 minutes away. Equities are declining by 0.8% on the S&P, down by 1 full percentage point and some on the Nasdaq 100. All awaiting for the same announcement, looking for 4 p.m. Eastern Time from the Rose Garden at the White House. The President of the United States unveiling the reciprocal tariff push we've all been waiting for. So equities are softer. Let's get you some morning calls. First up, Citi upgrading Charles Schwab to buy, pointing to an improving capital return story. That stock is higher by 1.3%. Your second call from Bank of America, lowering its price target on Morgan Stanley to 144, noting downside risk driven by policy uncertainty. We're down there by 0.8%. And finally, Raymond James downgrading United Airlines to mark perform, expecting the, quote, policy roller coaster ride to continue. That name is down by more than 2%. Delta earnings on deck a week today. Look out for the airlines just a week away. And then JP Morgan the following Friday. Lots of earnings still to come. We've got to get through the economic data first. ADP out just moments ago. Mike McKee has the number. Good morning, Mike.
Good morning, John. You asked a few minutes ago whether anybody's going to pay any attention to this, and I'm not sure they are. It's kind of a weird number, 155,000 jobs according to ADP, added in the month of March. That is significantly higher than the number of private sector jobs economists are forecasting for Friday is 135,000. And there's some underlying numbers in here that are a little odd. Manufacturing, according to ADP, added 21,000 jobs. According to the Economist survey, non-farm payrolls will find 0 jobs added in manufacturing. And we did see that disappointing hiring number from the ISM manufacturing report yesterday. Also, according to this, 41,000 jobs lost in the West, 29,000 of them in the Pacific. Maybe that has to do with the Los Angeles fires, but it seems a little late for that. The rest of the country adds a lot of jobs in New England, 89,000 jobs, never mind the weather in New England over the last month. So not sure what to make of all this, but there you go.
Well, Mike, we've put it together with all the other economic data we've had, particularly the survey data we've seen. You mentioned the ISM. We can look to consumer sentiment from you, Mitch, too. Mike, as we anticipate 4 p.m. Eastern Time, can you describe the position the U.S. economy is in going into this announcement?
I think somebody in the last week called it fragile, and that's probably where we are. There's underlying strength in especially the labor market, but there's a lot of concern among people about what might happen down the road. And as you get down into the lower economic strata, more worries than from the wealthier people. So, yeah, people could start pulling back if they come out of this announcement today with the feeling that things are going to get worse for them.
Mike McKee, appreciate the breakdown. Michael, thank you. ADP out just moments ago. Upside surprise, 155K. The estimate in our survey, 120. The previous number, a revised 84. The headlines we've had on the economy in the United States over the past week. Factory activity contracting. Prices paid, the highest since 2022. Consumer sentiment, the lowest since 2022. As for long-term inflation expectations, the highest going back 32 years. Anxiety around unemployment. 2/3 expecting unemployment to rise in the year ahead. Looking at that sentiment survey from you, Mitch, on Friday, that number, the highest reading going back to 2009. Mohamed's still with us. Mohamed, are things really that bad? When you hear those headlines, are they that bad?
I think people are worried, John. They are very worried. They're worried about demand slowing. They're worried about prices going up. And when you are worried, not only do you express your worry, but you start changing your behavior. I have talked to one CEO after the other, and they're saying we are going to wait and see. They are postponing major decisions, and for good reasons. You don't want to make a mistake right now. Just you're waiting for clarity. The problem is if we all wait, we create the reality that we're afraid of.
So this is really important. So we start the year, confidence is sky high. We're on this program, we're talking together, hoping because we all have the same trade on. We're long the US economy. We want America to succeed. We want that confidence to translate into hiring and investment. Then all of a sudden you describe a C-suite that goes into wait and see. How long can you sit and wait and see before things start to break in the wrong direction? Not hiring, but firing. Not investing, but something else.
It depends on your balance sheet. And that's why Mike was absolutely right when he said, look at the different levels of the income distribution, because people lower down do not have the resilience. A reality is we've run down both human and financial resilience over the last few years. And therefore, you cannot, there's certain segments of the population, there's certain segments of the corporate sector that do not have the resilience to simply wait. You know, the hard thing is, I think, if you ask most people, certainly if you ask me, if you're betting on an economy for the next 5 years, which one would you bet on? I say unambiguously the US, unambiguously. Then ask me, so how do you reconcile? When does this transition happen? And that's where we get paralyzed. We know that there's a transition out there, we simply don't know when it happens.
We should bring Binky back to bring some joy to the set. You know,
7K year-end.
I feel 7K. These things are going to just absolutely rip. The policy uncertainty will go away. It raises this question of whether this market is discounting the good data too much. And I say this with ADP employment change, and I understand it's ADP, but when it's bad and it confirms a bias in the market, then all of a sudden it's relevant. This is better than expected. Nobody seems to care. The markets aren't trading on it. If anything, you see equity futures roll over. I just wonder, are we ignoring data at our peril?
So we're ignoring data because this data is irrelevant compared to what's coming in the next few hours. And I think it's completely rational to ignore this data. I certainly would do the same thing. The information content of current data is much less, given that we have major paradigm shifts going on. Lisa, the last high for the S&P was a month and a half ago. This market and the investors have been conditioned over and over again to wait for the next high. That's been the absolutely right trade for years. So it takes a lot for the market sentiment to turn bearish in a permanent, in a sort of longer term sense than just a short term.
Well, but to build on what John is asking then, at what point does the idea of uncertainty as a policy become entrenched? And the idea that we're not going to get Binky's resolution that could lead to that 7,000, that there will be this sort of prolonged sense where people lack the confidence to make decisions?
So we heard it from Kalyan, ambiguity is the style. We heard it from Annmarie. It's not a bug, it's a feature. So I think if we all expect this uncertainty to lift at 4:05, we're dreaming. It's not. It's going to continue. And I understand why. It is good negotiating power. That's why I love the construct of game theory. This is not a game, but if you use the construct of a game theory, you understand much better. Is it a cooperative game? Is it a non-cooperative game? Are the two sides equal or not? They're not equal. Is it one round or is it multi-round? And if you start describing it like this, you find that it's in the incentive of the US to maintain ambiguity, to play a multi-round game, because it has the stronger hand. And that's, I think, what we're going to see from the administration.
When it comes to consumers, investors, executives, is it all driven, this anxiety, by policies and the tariff proposals, or was there a slowdown in the economy underneath policies before Trump even walked in?
There was fragility, to use Mike's term, at the lower end of the income distribution, but there was strength overall. Now we have uncertainty has spread both in the household and in the corporate distribution. So that is what's different. What we haven't talked about is Doge. I know a lot of people that are worried about the jobs, and they are looking at not just concerns about higher prices, but about income security. And we also need clarity on Doge. Are you remaking the government streamlined, debt dynamics under control, more efficient government, or are you breaking it? And remake versus break is an issue that we're going to also have to follow very closely going forward.
It could be an issue for this labour market. Mohamed, you're going to stick with us. We've talked about this repeatedly over the last few months. The transition from the public sector to the private sector is ambitious. It might turn out to be a good objective, but in the meantime, there might be some pain, and the administration themselves have talked about the so-called detox. In a moment, we'll talk about this economy. We'll catch up with Julia Coronado of MacroPolicy and Matthew Diczok of Merrill and Bank of America Private Bank. "60 minutes away from the opening bell, and equities heading south. We're down by 1% on the S&P 500. On the Nasdaq 100, we're down by 1.3. On the Russell, by 1.25. Binky, Chadha at Deutsche Bank getting a hard time on this program for a 7K price target. We've had cuts across the street from SocGen, from Yardeni twice, from Goldman twice, from RBC, from Barclays, and they have one thing in common. They all still expect this equity market to finish 2025 higher than where it is right now. Equity softer in the bond market. 2-year, 10-year, 30-year yields look like this. Yields are down by 3 or 4 basis points across the curve. The 2-year 385, the 10-year 412.50. Moments ago, the ADP report dropped, came in better than expected. An upside surprise, 155 versus an estimate of 120, and no one blinked. No one's paying any attention. The only thing they're paying attention to is at 4 p.m. Eastern Time, we'll hear from the President of the United States unveiling tariffs. And Fed Presidents Tom Barkin, Austin Goolsbee are both warning that tariffs could create a big challenge for the central bank. On the Fed Speak, here's Mike McKee. Good morning, Mike.
Morning, John. Well, it's basically what everybody from the Fed has been saying. We don't know what everybody everywhere has been saying. We don't know what the president's tariff regime is going to be like, so we really can't act on it. And that's what they're hearing from all of their constituents. Austin Goolsbee, the Chicago Fed president, saying yesterday that uncertainty is tinged with fear. And he says his business contacts are concerned and they want to sort of sit back and watch. Barkin suggesting a cage match between inflation and growth and basically laying out a stagflation dilemma for the Fed. So it is a situation where they don't know, so they can't say. Some people say that puts the Fed behind the curve. But really, in this case, I think doing nothing is one of the options. So they could be right on the curve at that point. I do think it's interesting, though, that Mohamed said it in the last hour, that the market doesn't believe the Fed is stuck. So it's going to be interesting to see what kind of reaction we get when we get to Jay Powell on Friday.
Mike McKee, looking forward to that address from the Fed chair on Friday, going into the weekend, following payrolls as well at 8:30 Eastern Time. We heard from the former Fed Vice Chair, Richard Clowder, on this programme just yesterday, who essentially implied this Fed would commit to being behind the curve, being late instead of early.
If they're waiting for the hard data to show this idea of slowing growth, they're going to be behind the curve because the leading indicators, if they are to be believed, are already indicating some sort of downturn. And if you get unemployment up to that 4.5%, as we heard from Jason Furman, at that point, is it just too late?
Let's talk about this economy. Here's a take from Julia Coronado of MacroPolicy Perspectives, writing, a recession has not become the baseline, though investors see the combination of Trump policies as a supply shock that the Fed's tools may not be able to address. Julia joins us now for more. Julia, you're super dialed into the FOMC, so let's get straight into it. Just from a cost perspective, by definition, the tariffs are paid by the importer. We've got that. How do you think the costs will be shared through the economy?
Well, it's going to be split between profit margin pressure and consumers' loss of purchasing power. And exactly how that breaks down sort of depends. We're not in the pandemic, so consumers they're not flush with cash. They're not just going to accept any price increase. And we've heard that in some of the comments to the surveys that have come in, that businesses are struggling with how to pass that on. How much will consumers bear and how much must they absorb? But it's going to be a hit in either way. It's going to be a hit to profit margins. It's going to be a hit to consumer purchasing power. And it will come with a burst of inflation. And that's the problem for the Fed. They're already above their target, never got back down where they wanted to be. And it looks like it's going to be a while before we get there.
Julia, one argument is that this Federal Reserve is very aware of the scarring that takes place when unemployment rises to a certain level, and they want to cater to the economy first, even if inflation does run a bit higher. Do you think that this market right now is misguided in their understanding that the Fed could cut rates by 3 times, even looking through some of those one-time inflationary pops?
I think the tension right now in the market pricing, as far as I can see, is it's perfectly reasonable to think that the Fed might lean towards the unemployment mandate and cut 3 times, but that means the economy has to be really bad. It means that the unemployment rate's not just up a tick or two. It means it's risen and is rising beyond 4.5%. We're sort of heading into a recession. And they need to start insuring the economy. That is the scenario in which the Fed cuts 3 times. It's a perfectly plausible scenario. We're sort of leaning in that direction ourselves. We could see a rising chance that we could see a recession in Q3 or Q4 of this year. And it's not just about the tariffs. It's about the combination of policies. One thing that we don't discuss enough is the disruption from DOGE cuts and contracts and disruption to sectors that are usually very stable, like healthcare, like state and local governments, that may start feeling the pinch, and they've been driving job gains. So we could see a turn for the worse, and that could lead the Fed to cut. But that doesn't seem to be the sort of sanguine middle road that the market is pricing in terms of equities.
So I'm trying to understand, Julia, how hard are you leaning into? Because the dominant view right now, to the extent there is a dominant view, is that the soft patch is in the next few months. By the time you get to the end of the year, you have deregulation kicking in, you have favorable things kicking in. Whereas you said the risk of recession is highest in the 3rd and 4th quarter, if I heard you correctly.
I have a very different profile from this idea we go through a soft patch. What drives growth up in the second half? Tax cuts, that's going to be that's a high bar because of the extension of the TCJA. You can play all the budget tricks you want. The reality of the macro impulse is that you're just not going to get that much fiscal impulse, very likely. And in fact, what we're seeing on the DOGE front is that you're going to get a lot of disruption in fiscal policy, whether or not those contracts are ultimately paid. Cutting them off and injecting uncertainty across a number of sectors is likely to dampen their enthusiasm or willingness to hire employees. Deregulation, we constantly hear this. I can see that in the finance sector. I can see that potentially more M&A, less bank regulation, or at least a lighter touch. But where else am I going to see it? Energy, already we had massive production, low prices. In fact, prices are too low to get much more production. Where else? Tell me the channel that deregulation is going to boost the economy in the second half of the year. What sector benefits from this?
Julia, when it comes to this holistic approach to the Trump administration, tariffs, deregulation, tax cuts, what you're saying there is that deregulation and the tax cuts, which to your point really are just tax extension of current policy, aren't enough to offset what the investors view as bad policy or less optimistic policy when it comes to the markets of the tariffs.
Exactly. And then remember, we're not just talking about tariffs. It's uncertainty around the tariffs. President Trump likes to hold that uncertainty over other countries, over essentially the economy. And so it's not going to just go away today. That today is just another sort of step along a road of an ongoing trade war of tariffs and retaliation. Then let's layer on the DOGE disruption to federal contracts. Then let's layer on the very restrictive immigration policy that is so draconian that it is leading a lot of workers, or at least some workers anecdotally, not to show up to work, not to engage in economic activity for fear of being snatched off the street and deported. And that has been, all of these things have been real tailwinds for the macro economy. The immigration piece is not insignificant. To go from an abundant environment of labor supply and growing demand to one where it's shrinking is a big shift in the environment. And we haven't yet seen that flow into the hard data, but I think the soft data is starting to pick that up. I noticed the comments to the Dallas Fed service sector survey yesterday were very interesting along these lines. They talk about the hit from immigration. They talk about what it's going to do in terms of constraining the construction sector. So, in Texas, we feel that. It's very direct. So, I think these things are going to come forward and show up in the hard data. And we're just focused on tariffs, but there's a whole range of policies that are not growth friendly.
It's a lot to get through. Julia, appreciate your perspective. Thanks for joining us. Julia Coronado there of MacroPolicy Perspectives. We're looking ahead to that address from the chairman of the Federal Reserve on Friday. By the time he speaks, he'll have all this information. We'll know what we get from the president at 4 p.m. Eastern time. We'll know what the payrolls report is at 8:30 Eastern on Friday. He speaks at 11:25 in the afternoon. We joked about this earlier this week. Obviously, someone aggressively rewriting this speech, like later today and again tomorrow and again Friday morning.
I mean, this is fascinating to me that he wants to speak right after the non-farm payrolls. What would he like to tell us? And this, I think, is really interesting. If Julia Coronado is correct, the bond and stock markets are singing from different hymnals. And how does he address that? The idea that the bond market seems to be predicting some sort of big downturn. And the stock market's super happy. So go figure.
Let's get to this bond market at the moment. Equities aren't happy. I wouldn't call them super happy this morning either, but let's get to this bond market. 2-year, 10-year, 30-year. 10s at the moment, yields at new lows for the year. The high for the year was the middle of January. It was 480. So we've dropped some 67 basis points off the highs of the year. We're down another 3 or 4 this morning. So are bonds back? Matt Diczok of Merrill and Bank of America Private Bank joins us now. Matt, are bonds back?
They never left. They never left. 60-40. The death is 60-40. Like Mark Twain said, his death was greatly exaggerated. So was the death of 60-40. No bad bonds, just bad prices. We had some really bad prices in 2020. When you got negative 2% real rates, listen, folks, not a lot of good things can happen. When we got to 2 to 2.5% real rates, good things can happen. You don't need commodities or other things to diversify your portfolio. When you have real yields, bonds will do that. And that was the story we were telling clients. Very concerned about tariffs being inflationary, not our belief, and I think the market is demonstrating that now. That the impacts of growth offset the bump in inflation. Bonds are doing their job in portfolios now, in our opinion.
So going forward, you're comfortable with 60-40 going forward. Are you comfortable with a globally diversified portfolio? What are you telling clients right now in terms of what will work going forward?
So we think 60-40 is too simplistic. We absolutely do believe, as you just alluded to, opportunities outside the U.S. Now, we believe in U.S. exceptionalism as a concept, but that doesn't mean that U.S. asset prices are always going to be the best. We are now in the 17th year of international developed equities underperforming U.S. equities. That is a pretty long period. Now, these cycles do take long times. It can be 10, 15-year cycles. But if you look at valuations abroad, they are cheap and extremely cheap to their usual level. They should be cheap, right? There's more old economy, financial services, energy, et cetera, outside the U.S. But even to a baseline level of cheapness, are quite cheap. So we do want investors to diversify throughout the U.S., but also we have added to Europe over the last couple of months in our portfolios. But we do want a healthy allocation to bonds and alternatives for clients who can take advantage of alternatives.
So what inning are we in, if you like? We've seen 70% outperformance of Europe vis-a-vis the U.S. in the first quarter. We're seeing somewhat of a convergence in valuation. But like you say, it's in historical term, it's pretty de minimis so far. How far do you think that convergence goes on? And at what level overall? Is it a convergence from the bottom? Is it convergence from the top? What happens?
Convergence more from the bottom. We think we're going to see an uptick in international valuations relative to the U.S. I'm thinking it's closer to 8th, 9th inning, possibly extra innings, but it's about time, we believe, for developed markets outside the U.S. to perform. Now, we might need to see a weaker dollar to actually have it come to that fore, but there's not a lot of things that would have to go right for international to do quite well. A weaker dollar could do it, better valuations could do it, sit here, get paid to wait with dividends can do it. So there are a lot of ways for a rebalancing of some performance from international equities to help out the U.S. portion of the portfolio.
And who is playing in this game? Is it the Mets or is it the Yankees? No, I'm kidding. Don't worry. We're Mets fans.
I'm living in 1986, so I'm still with the Mets.
There we go. Thank you. I appreciate that. I wonder if there's some conflict here with respect to this sort of bullish sentiment that bonds can work of all varieties and of all types. Bonds are back. This idea that credit can also work at a time when right now, if Julia Coronado is correct, the Treasury market is pricing in some more protracted downturn, at least than I've sensed from the stock market, which is not necessarily sad, but still, definitely not exactly pricing in recession. Is there a contradiction here in some of the pricing of some of the credit instruments beyond just treasuries?
It's very interesting. And Mohamed made some great points earlier on that game theory and multiple stages here are the way to think about it. What I think we're seeing for the bond market, and again, we're not overly enthusiastic about bonds right now. We like them more. We like duration more, closer to 5% on 10s. Now, low 4s on 10s, approximately close to 5% on the ags. We're neutral duration, neutral sectors. We think what the market is telling you is obviously the uncertainty around tariffs going to bring growth down. But everything here in the U.S., we have the strongest hand, as Mohamed said before. That's the right way to think of it. We got pocket aces, or worst case, ace-king suited. We have the greatest hand relative to the U.S. People want to come here, right? Demographics are a problem. Any problem you can think about, demographics being one, we can address that better than anywhere else in the world because people want to come to this country. So any problem we have, whether it's spending, whether it's demographics, we have the opportunity to solve that. So I think what you're seeing in markets is, should valuations come down a little bit? Should we have to see a little pain to get inflation off the 3%? Should there be a transition? Absolutely. But on balance, I think the markets are looking through this, that there's going to be some pain, but manageable, and both fiscal and monetary policy can recalibrate to get us through this without a recession at this point. But the window for good Fed rate cuts as opposed to rate cuts to deal with the problem, that window for good rate cuts, that is closing, to be fair.
So, and I have to be honest, my head's kind of spinning for a lot of reasons. I'm trying to think about cutting 3 times this year and how much that increases the chance of protracted inflation if we get ahead of any kind of downturn. If you get ahead of any kind of downturn, doesn't that allow the strength of this country that you just described to perpetuate any kind of inflationary shock that comes from the tariffs?
So, again, we're always very humble on what a policymaker is going to do. However, we think 3 rate cuts is probably too much. And actually, we saw a fraying of the 2-cut baseline. If you looked in detail at the last Fed meeting, 4 voters moved from 2 cuts to 1 or none. Only 2 more people moved. You got to 1-cut baseline. If you watched Chair Powell talk at the press conference, sometimes he was very, very confident. When he asked about a recession, didn't see that at all. When he got asked 3 times about the 2-cut baseline, he got a little less serious about that, because you can see, again, 4 people moved against that direction. So we would not expect 3 rate cuts. We're officially, Bank of America Research, expecting no cuts this year. But again, the point is, some of this uncertainty might be necessary. As Mohamed also said earlier, lower income is struggling, but higher incomes have still been spending. Huge asset price increases in housing and stocks.
Yep.
If you really want to slow down spending by higher income, then asset prices coming down a little bit, moderating a little bit, might actually be what you need to get those spenders to retrench a little bit, to help the Fed get inflation back to 2%.
Matt, appreciate your time. It's good to see you, sir. Thank you. Matt Diczok there of Merrill and Bank of America Private Bank. I want to pick up on that word humble. Humble, open-minded. Got to be open-minded. Consensus has been wrong at almost every single turn since the pandemic, coming out of the pandemic, as everyone's trying to cool this market and this economy. And let's see what we get later on this afternoon. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Rivian. Shares are falling 2.8% after the company reported first quarter production and deliveries that beat estimates. The EV maker delivered 8,640 vehicles, more than the expected 8,610. Rivian also reaffirmed its 2025 delivery range guidance of 46,000 to 51,000 vehicles. Turning to the Wisconsin and Florida special elections. In Wisconsin, the candidate backed by Elon Musk, Brad Schimmel, lost a judicial race despite Musk pouring millions of dollars into the campaign. And in Florida, a win for Republicans with Jimmy Patronis and Randy Fine both winning special elections bolstered by President Donald Trump's endorsement. And President Trump has said for months that the U.S. will take over Greenland one way or another. Now that rhetoric may be turning into policy. According to the Washington Post, the White House is drawing up a cost estimate to take over the Arctic territory. The report says one option being considered is to offer a sweeter deal to Greenland's government than Denmark. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. There's only one thing to look for. 4 p.m. Eastern Time from the Rose Garden, the President of the United States. Equities at the moment down 0.9%. The opening bout 38 minutes away. On the Nasdaq 100 down by more than 1 full percentage point. As we count you down to the big one at 4 p.m. Eastern Time. This is what things look like for the next couple of days. At 10 a.m., factory orders and durable goods. At 4 p.m., you'll hear from the President of the United States. Then on Thursday, those tariffs, many of which will take effect, including autos, get a round of jobless claims as well, so look out for that. On Friday, 8:30 Eastern Time, you'll have payrolls, plus Fed Chair Jay Powell will be speaking. Let's head down to Washington, D.C. and catch up with Mike Shepard for more. Mike, for people just waking up, just tuning in, getting ready for a long day and night, what is going to happen at 4 p.m. Eastern Time?
Well, at 4 p.m., we're going to hear from President Donald Trump making this announcement of what he has been heralding as the beginning of a new chapter in U.S. trade policy. He is intending to unveil these so-called reciprocal tariffs, as he's called them, that are designed to create a more equitable playing field for U.S. companies and for U.S. Exporters and for U.S. goods abroad. They have singled out different, what they see imbalances in trade with trading partners, including the European Union. And this will be an extension of the trade war he has already begun, with measures taken against Canada, Mexico, and, of course, China. And we're going to see also how that sits with those trading partners and with companies and investors. What kind of response will they take? Will we see trading partners immediately come back with some sort of reprisal or retaliation? The European Union has already responded in part to the tariffs that he has imposed on steel and aluminum. Canada, of course, has responded with tariffs of its own against the U.S. measures taken against the country just weeks ago. And China, too, is making steps of its own, calling for the U.S. to drop the tariffs that were imposed over fentanyl trafficking.
Hey, Shep, looking forward to your coverage together with the rest of the team down in Washington, D.C. Mike Shepard there of Bloomberg. Just enough time around the table to get a final word. Mohamed, first of all to you, please. A final word ahead of 4 p.m.
I'm not sure what that final word is, other than wait and see. And remember, this is a multi-round situation, not a single round.
That's the issue this market's got. What are we going to hear at 4 p.m.? How are other people going to respond? By other people, I mean the Europeans, the Chinese. How will companies respond? What will consumers do? Will they be able to tolerate higher prices? All things we need to think about going into 4 p.m. and beyond.
I'm less interested in the near-term response in markets than the longer-term timeline of the uncertainty and how long it remains in the system. And if people get the sense that this is a longer timeline, how much does that suppress some of these 7,000-like projections of the S&P 500 at a time when the uncertainty itself is having a drag? And that, I think, is what I'm looking for.
Today will not be the final word. To Mohamed's point, Kellyanne Shaw, I think, nailed it today. Ambiguity. That is how the president likes to operate. So when you go in today and you think about all these three proposals on his desk, universal tariffs, reciprocal, the Tchir approach, I think potentially we could see a hybrid of the two to assuage a number of concerns he has within his base and the larger Republican Party. But it is just the start. Then you're going to see negotiations take place, and also a very long line of companies that call the Oval Office, that call Howard Lutnick, that call Kevin Hassett and say, we have invested X amount of dollars into the United States. We hire this many people in a factory in South Carolina, even though we are a German brand. We're going to need exemptions. That's the next conversation.
That's what's difficult about this moment. Mohamed has said it repeatedly through this morning over the last 2 hours. I don't know. We don't know. And based on our reporting, even people inside the White House, they don't know either. Only one man gets to decide, and you'll hear from that man at 4 p.m. Eastern Time, live from the Rose Garden, an address from the President of the United States unveiling what he calls Liberation Day. From New York City this morning, a special thank you to Mohamed El-Erian. Up next tomorrow, Bob Michael of JP Morgan Asset Management, Jim Zelter of Apollo, former senior Trump trade advisor Katie Kalukowicz, and the U.S. Commerce Secretary Howard Lutnick, live on Bloomberg Surveillance at 8:30 Eastern Time tomorrow morning. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.